Okay, good afternoon, everyone. Welcome to Byju's Exam Prep IAS. This is Sham Kagud here. Now, before I start the discussion, if there is no issue with the sound, can you give me a thumbs up? Okay, done. Let's start then. Let's start. So, last week, what we have done, we started with taxation. I hope remember, we started with the concept of or the chapter of taxation. In taxation, we started with the terminology or the definition of a tax. What is a tax? Tax is nothing but it's a charge, it's a levy that is imposed by the government on the taxpayers. Now, the taxpayer could be you, taxpayer could be me, taxpayer could be a foreign company, taxpayer could be a bank, anybody on whom the tax will be imposed and collected. What is the reason? Why does government impose a tax? Reason is very simple. Government wants a lot of money which they will spend either for launching a scheme or for, let's say, construction of a road or a construction of an airport, etc., etc., etc. So the money can be used for any purposes that the government wants to spend it on. So that is a precise reason government will impose and collect a lot of these taxes. Now, in the context of taxation, after that we have discussed different types of taxation systems. Right? We discussed the concept of progressive, regressive, and proportional. We discussed the direct taxes as well as indirect taxes. We have discussed the countervailing, anti-dumping, and safeguarding duties. We have discussed cesses and surcharges. So these are certain very important terminologies or let's say concepts related to taxation which we have covered so far. Now let me pick up from where we actually left off last week. That is basically further discussion on the specific types of taxes, some of the direct taxes, some of the indirect taxes. Now before I start, there are hundreds of direct taxes, hundreds of indirect taxes. You don't have to read all of these taxes, right? Let me know if my point is clear or not to you people. At the central level, at the state level, there are 100 types of taxes which are implemented by both center as well as state. You do not have to read all of them. Not at all relevant. Not at all relevant for UPSC. Now, what are the taxes that you will have to read then? The important taxes which are there in the newspapers, please focus on that. For example, income taxes anyways are relevant. Corporate taxes, GST, right? Capital gains tax, retrospective tax, etc. These are certain types of terminologies which are relevant for UPSC. Please read those types of taxes. Now, I hope remember the taxes are divided into two types, direct taxes as well as indirect taxes. Now, within the direct tax, let me discuss certain types of taxation. Income tax. Within income tax, there are two types of taxes, individual income taxes as well as corporate taxes. Now, first and foremost, what do you mean by income tax? Look at the name itself, right? Don't you think the name itself is an indication of what type of tax it is? That is, on certain amount of income that is earned, government will impose the tax and collect the tax. And because we are implementing the tax on the income and collecting it, it is called as an income tax. Now, right now, understand the next point here. Government of India imposes and collects the income taxes based on the act of the government, which is called as the Income Tax Act of 1961. Is it okay? It is referred to as Income Tax Act of 1961. For example, if you're paying income taxes, government will change the income tax rate as proposed very recently. That will be done by introducing a provision under the Income Tax Act of 1961. Government will change the corporate tax rate. That will be again done by changing the provisions under the Income Tax Act of 1961 itself. So under the Income Tax Act of 1961, two more types of taxes are imposed. That is one on individuals. Individuals means what? You are an individual, I am an individual. That is one type of a tax. and the second one on the profits earned by the companies, that is called as a corporate tax. Is it clear or not? Let me know. Under the income tax, government imposes taxes on individuals such as you and me, right? On whatever incomes we earn, on that government will impose and collect taxes. And the other way to collect income tax is government will impose taxes on the profits earned by the companies and collect the taxes from the companies. One is called as a corporate tax, second one is called as an income tax. Now, if you talk about income taxes, basically understand the logic. It is imposed on individuals such as you, me, your neighbor, your parents, etc. But right now, there are two systems of income taxes collection. You don't have to by heart the numbers there. What do I mean by that? Under one of the systems, we have 0%, 5%, 10%, right, 20% and 30%. 5% has been removed. We have simply 0, 10, 20 and 30%. And the other one, we have 0%, 5%, 10%, 20%, 30%, many more slabs are there. Now, if your question is, sir, should I by heart both of the income tax systems? Then my argument to that will be absolutely no. Please do not by heart, okay? Please do not by heart the income tax, let's say the numbers or the system that has been proposed by the government. UPSC will not ask you that. But it is just suffice to know that based on the income that the people are earning, government imposes and collects income tax from them. That is one. Second, corporate tax. Right now under the corporate tax, which is much more relevant for UPSC examination, we have, right, three systems. That is one, the one system where we will impose a 30% corporate taxation, and another where we will have a 22% corporate taxation, and the third one specifically for certain manufacturing companies, which is 15% corporate tax. Is it okay? Let me know if you're finding it difficult. Under the corporate tax, we have basically one. Until now, we had only one, 30% corporate tax. For example, imagine there is a company which has earned a profit of 100 crore rupees. If I calculate a 30% tax on this, is it okay if I say the company has to pay 30 crore rupee taxes to government? Apart from this, we also have one more system where 22% is available to you. Now, some of you will ask me, sir, if 30% is also there, 22% is also there, why will I choose 30% or why would I be happy with 30%? Obviously, I will choose 22%. The argument is very simple. There is a concept called as deductions. Remember this. There is this concept called as deductions whenever you talk about taxation. What is the meaning of a deduction? I'll give a very simple example. Imagine you are a person who is earning income of 5 lakh rupees. Your salary is 5 lakh rupees. But next point is important. Government will not collect taxes from full 5 lakh rupees. I hope you understand. Government will not impose the tax on full 5 lakh rupees. No, they will not do that. This is your salary. From this, I will reduce 2.5 lakh rupees. I will reduce 2.5 lakh. Why? Many of you ask me, sir, why? Why did you reduce 2.5 lakh? Because for the first 2.5 lakh rupees, tax rate is 0 rupees. That is 0%. So on the first 2.5 lakh rupees, you don't have to pay any income tax to government. Now, if you deduct or reduce 2.5 lakh, how much is left out? Another 2.5 lakh. Now, please understand this. On this 2.5 lakh rupees, does government impose a tax? Ideally, they should do. But what government says is, if you have invested under Section 80C of IT Act. Now, many of you will ask me, sir, what is Section 80C, etc. You don't have to be worried. Please understand the example here. Imagine you have invested in PPF, Public Provident Fund. Government says, use it as a deduction because you have invested in the PPF. I will not collect taxes on this. You have paid housing loan. Government says if you have paid housing loan on the amount of money up to certain limit, I will not collect the taxes on this. You can pay it. So let's say hypothetically, right? Have a look at this hypothetically. Out of 2.5 lakh rupees, 50,000 rupees you have paid to Public Provident Fund, PPF. From 2.5, 50,000 will be deducted. What you get is 2 lakh rupees, and this is called as taxable income. This is referred to as taxable income. So government will impose taxes on this and collect it from you. So I hope you understand. Whatever is your salary, on the full salary, tax is not imposed and collected. Certain deductions would be allowed, and out of the remaining amount, after the deductions are out, taxable income or net income will be imposed with the taxes and collected. Now come to the point here. Come to the point. Don't start running behind section 80C, PPF, etc. That is not at all relevant. UPSC will not ask you that. Focus on what is relevant. Now, one of the systems is 30% corporate tax. Second is a 22% tax. If you are given a choice, obviously you will choose 22% tax rate. But government says, if you choose a 22% corporate tax rate, I will be not giving you any deductions. Is it okay? I'll repeat it. If you choose a 22% corporate tax rate, I will not give you any deductions, right? Means any kind of a investment that you have done, you want to claim it as a deduction. If you choose to pay corporate taxes at 22%, no deductions will be provided to you. So one is a 30% corporate tax rate. Of course, you are given, right, with the deductions here. 22%, no deductions. And the third one is 15% only on some of the manufacturing companies which have started manufacturing in the next 1 year till the end of financial year 24. They will get the advantage of paying corporate taxes at 15%. Now there is a discussion whether this introduction of lower tax rate, lower corporate tax rate, is it good or bad for the economy? Let's make a critical evaluation of this. What are the benefits? Why has the government of India reduced corporate tax rate? What are the advantages? And if they have reduced it, what are the issues and concerns? Let's try and understand. First one, it will attract a lot of investments into the domestic market. Now you'll ask me, sir, how? Let me give a very simple example. Imagine you want to invest in one country, the corporate tax rate is 30%. In another country, the corporate tax rate is 20%. Answer to my question, where would you want to invest? In country A or country B? There are two countries. In one country, corporate tax rate is 30. Another country, corporate tax rate is, right, that is country B, 20%. Where would you want to invest? Obviously, we will choose country B. So one of the advantages, some of you are saying, A, how? Just think of it, no? You are an investor, you are a company, you want to pay higher taxes to government, right? Apply basic common sense, you will understand. So you will basically invest in country B where the corporate tax rate is lesser. So one advantage that we are expecting is it will help in attracting a lot of investment into the domestic market. Second, ease of doing business. Now very often you will come across the terminology called as ease of doing business. Understand this very carefully. Whenever government uses ease of doing business, what are they simply referring to? Simple logic here. Whenever you want to start a company, whenever you want to conduct a business, don't you think there'll be certain guidelines that you'll have to follow? Right? I hope you understand my logic here. Whenever you want to start a company, you want to launch a business, you'll have to follow certain guidelines. Sir, what do you mean by that? Imagine you will have to get licenses from the government. So my question to you people is, would you want a system wherein only one authority will give you all the licenses that you require, or a second system where you will go to many of the central government authorities, many of the state government authorities to get the licenses? Don't you think by implementing a system where you can get all the licenses from only one authority, that will make it very easy for conducting business in a country? And I'll give you current affairs. I'll connect it to current affairs so that you understand what is actually being discussed. Very recently, there has been a system which has been introduced by the central government by the name of National Single Window Clearance System, NSWS. Please make a note of it. NSWS, National Single Window System. What is the idea of a National Single Window System? Rather than running from one ministry to another ministry to get licenses or approvals, both at the central government as well as the state government level, you can simply apply for all these approvals under only one portal, that is NSWS. And once the class is over, this is where I want you people to read current affairs, read newspapers. Once the class is over, just type NSWS in the Google and you will see in the last 1 week, there was a discussion in the newspaper regarding that. Right? So understand the logic here. By reducing the corporate tax rate, we will promote ease of doing business in a country. We expect a lot of investments to be made in the domestic market. Third, lot of these companies have been demanding, that corporate tax rate be reduced. I'll tell you the reason. If you look at the USA, the earlier administration or the earlier president of USA actually reduced the corporate tax rate from 35% to 21%. And it is not just, it is not just connected to the USA. Many other countries also have reduced corporate taxes. So even in case of India, the companies are asking government of India to reduce the corporate tax rate so that the tax burden on them will automatically come down. The government expects a lot of these private sector companies to start investing, and that will basically lead to virtuous cycle in the economy. Any issue with this? Let me know. The private sector investment will increase, and that will lead to virtuous cycle in the economy. That is, investment will take place, employment will be generated, demand for raw materials will increase, and contribution to GDP will also increase, etc. So these are some of the advantages citing which government of India has actually launched, or let's say has actually reduced corporate tax rate. I'll write one more advantage here, or one more objective of the government of India. Government of India wants to phase out various exemptions that they are providing, exemptions or deductions that they are providing to companies. I will repeat the statement. Government of India wants to phase out means basically remove all of these exemptions or deductions that they are providing to these companies. I'll tell you why this is much better system. Follow this carefully. Imagine there are two manufacturing companies, A and B. A is a very, very small manufacturing unit, and B, just for sake of understanding, it is, let's say, Tata company, or for that matter, let's say, right, Reliance company, etc. Now, I'll ask you a very simple question. Think of it and answer. Government of India has provided a lot of exemptions, deductions to companies. You invest here, you will get a deduction. You purchase this, you will get a tax exemption, etc., etc., etc. Now, simple question to you people. Between these companies, let's say A and B, which company do you think will be getting lot of these exemptions or deductions? Which company has, let's say, appropriate manpower to leverage and get all of these deductions? Right? The answer is very simple. It is the second set of companies. So argument of the government is, I'm providing deductions, I'm providing lot of tax exemptions. It is being utilized by larger companies more compared to smaller companies. So what is the best way then? I want the smaller companies to utilize it. They are not getting majority of the benefit. It is the bigger companies. So what is the best way forward then? Simply phase out exemptions. Remove all these exemptions. But if I want to remove these exemptions, I will have to ensure that the companies will start shifting from a tax regime where exemptions are provided to another tax regime where exemptions are not provided. That is the reason why Government of India has actually reduced the corporate tax rate. And so these are the advantages. What are the issues or concerns? What are the issues or concerns? One, if government will reduce the tax rate from 30% to 22%, don't you think the direct outcome will be the tax amount that is collected by the government automatically will come down? Right? I hope you understand it. I'll repeat it again. If the government will reduce the tax rate from 30% to 22%, don't you think the amount of taxes the government will collect will come down? Of course, the answer is yes. Sir, how much? Again, this was there in the newspaper very, very recently, because the parliamentary discussions are happening now. The Government of India has told the parliament that so far, because of the lower tax rate, Government of India has to forego 2 lakh crore rupees. I will repeat the statement. Government of India has to forego or has had to forego more than 2 lakh crore rupees. What is the meaning of it? If it was 30%, I would have collected extra 2 lakh crore rupees. But because I've reduced it to 22%, I was not able to collect this 2 lakh crore rupees. So first impact is tax revenues have actually been affected. Second, investment to increase in the economy. Tax is one parameter, one factor. But apart from taxation, government needs to implement reforms in other areas as well. I'll give you examples, just have patience here. Very recently, there was a discussion regarding bullet train project. How many of you read it in the newspaper? Very recently, there was a discussion regarding bullet train project, right? That is, one of the high courts has given a verdict regarding bullet train. And in fact, some of you will simply say, sir, in which newspaper it had come, etc., etc. It came in Hindu newspaper. You can check after the class. It actually came in Hindu newspaper itself. And the argument in the article was very simple. Again, let's not get into the discussion related to that. I want to connect it to this point. That's the reason I'm talking about it. In order to construct a mega project such as bullet train, you'll require land. All of you will agree? You will require land. And in order to get this land, please understand this. Government of India has been facing a lot of difficulties. Simple. Right? Why? Land acquisition in India is not easy. I repeat, acquiring land in India for infrastructure projects is not easy. Right? Please remember that any answer that you are writing related to infrastructure in India, mention this. Definitely, yes, it's a good point. It is not easy to get access to land. Not easy to acquire land. Now, many of you ask me, sir, why? Why it is not easy to acquire land? I'll give a very simple example. Lot of these lands which are there, which can be acquired by anybody, either you, me, companies, government, etc. Lot of these lands are under dispute. They are under dispute. Dispute means what? Two siblings are there. Both of the siblings will claim that the land belongs to them. They will go to court. Simple. Or I have purchased the land. You will come to me and say, sir, the land belongs to me. Somebody has cheated you. Chuna lagayega. Right? So somebody has cheated you. The land belongs to me. Right? You will also file a case. I will also file a case. So a lot of these lands are under dispute. So not easy to acquire land in India. Right? So understand the logic here. You want to attract a lot of investments. Agreed. Private sector will not just look at tax rate and start coming to India. They are worried about land acquisition. They are worried about skilled labor. Very, very important. Later in the discussion, not today, not next week also, in the 5th week, we'll have a discussion related to problems of skilled labor in India. I will tell you, the availability of skilled labor is very, very less in India when you compare with, let's say, China, when you compare with the USA, Germany, Britain, Japan, etc. So don't you think a private sector, whenever they want to invest, they'll be concerned about all of these factors? Simple. Don't you think they'll be concerned about all of these factors rather than focusing only on one parameter? Again, I'm not saying that, right, this policy is bad. Please understand my statement. All I'm saying is government should also focus and implement reforms in all these areas which they are actually doing. Next one, there are various other policies of the government itself that may hinder the investments in the market. So what do you mean by that? I'll give a very simple example. Government of India wants to promote manufacturing in the domestic market. All of you will agree? Government is promoting manufacturing in India. But imagine you're a foreign investor, you will set up a manufacturing facility in India. You want to import a machine because that machine is not available in the domestic market. Now, don't you think if government imposes a higher tax rate on the import of the machine, that will affect your investment in the domestic market? Right? Yes or no? Please let me know. Right? Whether you're understanding or not, that is relevant for me. So all I'm saying is, you're a foreign company, you have come to India, you want to invest, but to manufacture the product, you need to import a machine. Government says, I will impose a higher tax rate on this when you import. Right? Don't you think that will basically reduce the investment in the domestic market? Right? So understand there are various policies. Again, don't worry about today itself. As and when we go, more and more industrial policies will come across. Why these are counterproductive, why these policies are problem policy, etc., etc. You'll understand one by one. Not today, one by one you'll understand it. Okay, so there are various policies which are taken by the government which are basically counterproductive, which will affect investment in the domestic market. So this is the discussion regarding personal income tax and corporate tax. There is one more concept related to corporate tax, that is the minimum alternate tax. Just give me some time, I'll cover that also. Third type of tax is capital gains tax. Let me explain what is the basic idea for capital gains here. Imagine today you will go to market, purchase an asset. Right? What do you mean by asset? Asset could be, let's say, a painting. Asset could also be land. All of you will agree? Asset can be a painting also. Asset can be a land also. But what is the basic difference between a painting and a land? One is movable, second one is non-movable. Any disagreement? Let me know. Land is non-movable. Non-movable means it is fixed. And the other one is movable. You can move the painting left, right, center to right, a gallery to somebody else's house, etc., etc. Now, why this kind of a differentiation is required, you will understand in a minute. But please understand this. You have purchased the asset, let's say, at X rupees. Now, after certain time period, you will sell it in the market at price Y. I'll repeat it. Today you have money, you will purchase an asset, either movable, immovable, don't worry, you have purchased an asset. You will own it, and after certain time period, you will sell the asset in the market. And let's assume the price that you get after selling is greater than the price that you paid to get the asset. Now, is it okay in common man's language, in layman language, is it okay if I call this as a profit? That is the difference between Y and X. Can I call this as a profit? Right? Let me know if you disagree. Y is greater than X, by the way. Right? In a layman, common man's language, if Y is greater than X, it is profit. But please understand, rather than calling this as a profit, the tax will call this as, or income tax will call this as capital gains. The tax officials will simply call this as capital gain. Capital again refers to asset itself. Last week also we have come across the concept of capital. Land, labor, capital, etc. Capital always refers to assets. So you have purchased an asset and sold the asset after certain time period. And the price that you got after selling is greater than the price that you pay. For a common man, this is profit. For Government of India, because this is an asset, we'll call this as capital gains. So far, so good. Now the capital gains tax is applicable on movable asset as well as immovable asset. Simple. It is applicable on the movable asset as well as immovable asset. On both of these, the capital gains tax is applicable. But further within the capital gains tax, we will divide that into two types. One is called as a short-term capital gains tax, and the other one is long-term capital gains tax. Right? That is LT-CGT, ST-CGT, short-term, long-term. Now, what is this concept of a short-term and long-term? Logic is very simple. Traditionally, when the capital gains tax was implemented, we assumed that if you purchase an asset, sell it before 3 years. I can write it as before or within 3 years. I repeat, understand this. Traditionally, when the concept was implemented, right, when the idea of capital gains tax was implemented, government said, if you purchase the asset and you sell it before 3 years or within 3 years, I will basically impose a tax which is called as a short-term capital gains tax. And if you sell it after 3 years, I will call this as a long-term capital gains tax. That is the tax which is applicable on the capital gains. Let me ask you a simple question just to make sure that you have understood it. Have a look at this. Imagine you purchase an asset in 2020, you sell the asset in 2025. Now tell me, is short-term capital gains tax is applicable or long-term capital gains tax is applicable for you? Right, let me know. Is it short-term or long-term? Long-term, all of you will agree? Long-term. Why? More than 3 years. Now, if you purchase the asset in 2020 and you sell it in 2022, short-term or long-term? It will be simply short-term. So understand the logic here. It was very simple. When we introduced it, it was very simple. We simply assumed if you sell it after 3 years, I will impose long-term tax. If you sell it before 3 years, I will impose short-term tax. But government changed these long-term and short-term for different assets, thereby making it much more complicated. So what do you mean by that? Let me give you a very simple example. Today, if you go to the stock market, purchase shares of Adani company. I'm pretty sure all of you heard of Adani, right? Again, not specifically Mr. Gautam Adani. I'm talking about Adani company. You purchase the share of Adani company and you sell it within 12 months. Remember, within 12 months, right? That is rather than 3 years for shares. Now it is 1 year or 12 months. So if you purchase shares in the market and sell them within 12 months and the selling price is greater than the price at which you purchased, then basically the tax that will be imposed on you will be short term. Is it okay? The tax that is imposed on you will be short term. So for securities, it is a short term if you sell it within 1 year. Sir, what if I sell it after 1 year? Tax rate is long term. For land, if you purchase the land and sell it within 2 years, short term. More than 2 years, long term. So again, you don't have to buy out all of these tax rate. Now come to the point here. Sir, why are you telling all of this? Come to the most important point. You tell me, having only one time period to define what is short term and long term, is it good? Or having multiple time rates or multiple, let's say, times for different assets, is it good? Obviously, you'll have to choose. Understand this. Obviously, you'll have to choose, right, basically a time frame where it is uniformly applicable for all the assets so that it is very easy for implementation purposes. And that is a precise reason. That is a precise reason experts wanted the government of India to make changes in the capital gains tax. Right? They wanted the government of India to make changes in the capital gains tax. But understand the logic here. Government of India very recently in the budget has not made any changes in the capital gains. They have said whatever the system we have, we will continue with the same system. But having said so, we are expecting changes in the capital gains tax at least in the coming days. Because right now, for different assets, tax rate is different, time period is also different, which makes the whole process very much complicated for implementation. So we need to rationalize, we need to simplify the capital gains tax. Done? Right, so this is basically the discussion related to the concept of capital gains tax. Now, I'll connect to certain important current affairs. Concept of tax avoidance. Idea of a tax avoidance. Now, please understand the meaning of the term tax avoidance. Whenever you use the term tax avoidance, it simply means the taxpayer is taking certain action. Action means taxpayer is doing something, as a result of which the tax burden, the taxes that is paid will automatically come down, and nothing that the taxpayer is doing is illegal. Is it okay? This is a definition. Let me know. I'll repeat it again. What do you mean by tax avoidance? It refers to certain actions or activities of the taxpayer which are done in order to reduce the tax liability, that is the taxes paid by the person, and none of these actions are illegal in nature, which means you can take them. Government will not hold you, right? Let's say government will not say you are doing something illegal. You are not doing any criminal activity. That is the simplest meaning of it. Is the definition of tax avoidance okay? I'll repeat it again. Tax avoidance refers to action. Action means what? Something that you are doing. Action of a taxpayer, as a result of which the taxes that you pay will come down and nothing is illegal here. That is called as a tax avoidance. Now, some of you will basically say, sir, why? Why are we going for a tax avoidance? My dear, very simple. You want to pay higher taxes to government or lower taxes? Just think of it, right? If I were to ask you, imagine you're earning 1 crore rupee income. Would you want to pay out of this 30 lakh rupees or 10 lakh rupees in the form of income taxes? Which one will you choose? Some of you might simply say, sir, I want to serve the country, so I will pay 30 lakh rupees. But when it is a question of actually paying the taxes, you will simply choose a lower one, that is 10 lakh. Now, if you want to pay lower taxes, don't you think everybody else in the economy, companies, investors, they would also want to pay lower taxes in the economy? So how do you reduce the tax liability? You can go for tax avoidance. Now, how can you go for a tax avoidance? I'll give a very simple example. Have a look at this. Follow this very carefully. I'll give you one example. There is a practice which is followed by the companies, which is called as a transfer pricing practice. Right? What do you mean by transfer pricing? I've given the definition in the bottom part of the slide. Follow the definition, then I will show you the application part of it. Transfer pricing basically refers to the accounting practice of companies when goods or services are exchanged between them. That is, let's say a company is selling goods to another company B. How do we account? Account means how do we basically write what is the price of the commodity? What is the price of the good or service that is sold and bought? That practice is called as transfer pricing. Now, why that is relevant? Understand this very carefully. Imagine there is a company ABC in country 1. I'll come to the terminologies, have patience. There is another company XYZ in the second country. And let's assume in the second country, the corporate tax rate is 22%. In the first country, the corporate tax rate is 5%. Now, before I go forward, let me ask you a very simple question. If you are the person who is going to pay corporate taxes here, where do you want to pay the corporate taxes? Would you want to pay the corporate taxes in country 1 or country 2, or the first country or the second country? Where do you want to pay the corporate taxes? Obviously you will choose country 1. But let's say hypothetically you are present in the second country. You are basically manufacturing, selling the goods, etc. in the second country. But in the second country the tax rate is 22%. Now what do you do? How do you ensure that you are not doing anything illegal, but you will reduce the amount of taxes you will pay to the government? Let me show you one example. Right, so what you will do is you will basically set up one more company, right? Let's say company ABC in the first country where the corporate tax rate is very, very low. And imagine you want to purchase certain raw materials. You want to purchase certain raw materials, certain machinery, etc., so that you can produce this bottle in India, sell it. Now, let's say hypothetically, you purchase certain machinery to manufacture the bottle. Now, follow my question and answer this. What if I say, rather than spending 20 crore rupees to purchase a machine, you will spend, let's say, 50 crore rupees to purchase the same machine? I hope you understand. I'll repeat it. Rather than spending 20 crore rupees and purchase a machine, you will spend 50 crore rupees, purchase the machine, produce the bottle in India, sell the bottle in India. Now, simple question to you. If I say situation 1, you will purchase the machine by paying 20 crore rupees, and situation 2, you will purchase the machine by paying 50 crore rupees. Now, imagine everything else is same, nothing changes. Answer to my question. In which of the two situations you will have higher profits? Let me see. Right, in which of the two situations you will be reporting higher profits in India? Is it okay if I say situation 1? In the first situation, because the cost of the machine that you have recorded is 20 crore, you will be earning higher profits compared to second situation where the cost of the machine is 50 crore. Now follow this next point carefully. What you will do is, understand this, what you will do is, you will purchase the machine, that is company XYZ will purchase the machine from company ABC. Both of them are related. Both of them are related means what? The owner could be, let's say, another company EFG. Have a look at this. Owner of both of the companies is the same, right? EFG, company EFG. So don't you think both of the companies are related to each other? Right? They are owned by the same entity like this. So follow the next step carefully. You want to purchase a machine. You will purchase the machine from another company which is located in a country where the tax rate is very, very low. Rather than purchasing the machine at 20 crore, you will purchase it at 50 crore rupees, which means the profits that you have earned in second country, the profits automatically will come down. All of you will agree? Profits will come down, and because the profit will come down, what about the taxes that you pay to the government? The taxes that you pay to the government will automatically come down. Any issue with the system? Let me know. Any issue with the system? Now, what is the outcome, sir? Why are we doing all of this circus? Simple. This company ABC, which is set up in the country 1, has earned higher profits now because they have sold the machinery to the company XYZ. They have earned higher profit, and when they have earned higher profit, right, they will have to pay taxes to the government. But the tax rate in the second country is how much? Or country 1 tax rate is how much? 5%. So will they pay very, very high rate of tax or low rate of tax? They will end up paying very small part of the profit to the government, right, thereby, right, reducing the tax burden on the company. Is it okay? Right, I'll repeat the process here again. It's very simple. Don't complicate the system. Let's go step by step. What I'm saying is, imagine company ABC is set up in another country where the tax rate is very low. Company XYZ is set up in second country where the tax rate is very high. if the company XYZ will purchase the product from somebody else in the market, they can get it, let's say at 20 crore, 30 crore, or even let's say 40 crore. Right? Thereby manufacture, sell, earn profit, pay taxes to government. But rather than purchasing from anybody else, they will purchase it from one more company which is related to the same company. But this company is located in another country where the tax rate is very, very low. So what this company will do now? The XYZ will purchase the machine, ABC will earn a profit, part of the profit they will pay to the government, but the tax rate is very, very low in the country one. Whereas because XYZ has purchased a machine from another company, the expenditure of XYZ would automatically be higher, profit would be lower, and thereby the taxes which are paid to the government would also automatically be lower. Now have a look at this. Right, have a look at this. Is it illegal? Right, illegal in the sense, is it illegal for XYZ to purchase machine from ABC? You tell me. Is it illegal? If you set up a company in India, can Government of India tell you not to purchase a machine from one more company? No, it is not illegal. Point one. Second, is it illegal for you to set up one more company in another country? I hope you understand. Is it illegal for you to set up one more company in another country? Again, it is not illegal. But what you are doing is, understand the logic here. By setting up one more company in one more country where the tax rate is low, generating profits in that country, you are paying lesser taxes, thereby doing this. Simple. Some of you will ask me, sir, why? Why are we allowing this? It's not illegal. You can do that. And some of you will ask me, sir, how the taxes paid to the government is coming down? My dear, rather than setting up one more company in the country one, can you set up the same company in country two? Just think of it. I hope you understand. Just think of it. Can you set up the same company ABC in the second country as well? Of course, yes, you can set it up. But why do you go outside India and set it up? Because in India, the corporate tax rate is, let's say, 22%. In another country, the tax rate is much, much lower than this. So you have earned, let's say, 100 crore rupee profit. Again, my question remains the same. Through company ABC, you want to earn 100 crore rupee profit. Would you want to pay taxes at 5% rate or taxes at 22% rate? Right? You already know the answer to this. Right? So this is called as basically the transfer pricing practice. Now, understand the next point carefully. Can we attribute transfer pricing practice to foreign companies? Is it possible? Can the foreign companies be involved in transfer pricing practice? Let's say a company, foreign company, it is located, it's manufacturing in India, but will purchase, let's say, a machinery from another company owned by the same company, but located outside India. Can it be attributed to foreign investors in India? Can it be attributed to domestic companies also which are set up in India? Answer is simply yes. Now, you are the Prime Minister, right? 1249 or let's say 1250, you are the Prime Minister. Are you happy with this? Will you be happy with the transfer pricing practice followed by the foreign companies? Answer is, sir, no. Right? Some of you are saying yes. No, my dear, you should not be happy. Why? If you are the Prime Minister or if you are, right, having the government in the second country, because of this transfer pricing practice, the taxes that you are earning are becoming low. Does it make sense or not? Let me know. Right? You are the government in the second country. Because of this, the tax revenue that you are collecting will automatically go down. So what you will do now? You will basically implement a system which is called as advanced pricing agreement. Understand the next point carefully. Right? In case of India, the CBDT, Central Board of Direct Taxes, has introduced a system called as advanced pricing agreement. Right? What is this advanced pricing agreement? I'll give a very simple understanding. Follow this carefully. Imagine you are the owner of company XYZ. Imagine you are the owner. Now you want to import a machinery from company ABC, and obviously when you import, you will have to pay certain taxes on it. Now, even before importing, you will approach the tax authorities and seek clarity on the type of taxes which are applicable and whether this kind of import is allowed or not. I'll repeat it again. What is this advanced pricing agreement? Basically, this is an agreement between the tax authorities as well as the various investors or the governments across the globe. Under the advanced pricing agreement, why this is called as advanced? Even before you import anything, you will get the clarity from the tax authorities whether this import is allowed. If it is allowed, at what tax rate the import will be imposed with, etc., etc., etc. Now, some of you will ask me, sir, why? What is the need for it? Now, rather than being an investor, imagine you are a tax professional. You are a tax authority. A company will approach you. They want to import a machinery from, let's say, Singapore. Now, you look at the machinery value. You will ask for clarity. Why? When the machine is available at, let's say, 40 lakh rupees somewhere else, why are you importing from specific company? What is the objective? If you are going to import it, this is the amount of a tax I'm going to impose, etc., etc., etc. This is called as advanced pricing agreement. So is the logic okay here? This is basically the process that is followed. Tax avoidance is basically any activity that the taxpayer takes as a result of which the tax liability will automatically come down, and this is not illegal. It is perfectly legal. But if you are involved in the tax avoidance, the government is worried because the amount of taxes that able to collect will automatically go down. So what can be done? For that itself, there is a concept which has been implemented by the government of India, which is called as advanced pricing agreement. Right? So this is one example. There are multiple ways through which you can address the issue of tax avoidance. I'll come to that one by one. We'll have a discussion. Now, one more concept related to tax avoidance is base erosion and profit shifting. Base erosion and profit shifting. Very, very famous. Very often cited in the newspaper. Let's try and understand this. Now, first and foremost, there is a term called as tax base. Understand this very carefully. There's a term called as tax base. What is this tax base? It is an object on which government will impose and collect a tax. I'll repeat it again. It is an object on which government will impose and collect a tax. Right? Is it okay? I'll give you examples. Right, sir? Any example of a tax base? I'll give you examples one by one. Let's have a look at it. What if I simply tell you, until now, follow this carefully. Until now, on the flask, tax was not imposed. Now the government is imposing tax on the flask or the bottle and collecting taxes. Look at the next statement and let me know whether this is correct or not. With government imposing a tax on the bottle, the tax base has widened. Is it okay? I'll repeat it again. Right? Understand the situation. Until now, government did not impose a tax on the bottle. Now the government is imposing tax on the bottle and collecting taxes. Now, if this is the situation, can I conclude that with the imposition of a tax on the bottle, the tax base is widening? Any disagreement? Whether you are understanding or not, please let me know. Tax base will widen. I'll give you a second example. Right now, if you earn income through agriculture, Government doesn't impose a tax on it. Is it okay? It's a fact. Remember this. If you're earning incomes through agriculture, government doesn't impose a tax on it. Now imagine tomorrow government will basically say, even if you earn income through agriculture, I will impose a 10% income tax on you. With this, can I again say tax base is widening? Agreed or disagreed, please let me know. If more and more commodities are brought under GST, tax base will widen. If all of you who are earning income, you don't pay taxes to the government, tax base will become narrow. Right? I hope you understand what is the context, why they use the term tax base, how to use it, etc., etc. So argument is simple. First, you will have to look at the term tax base. Now it should be very clear to you what is the meaning of the tax base. Now come to this picture. Come to this picture. Is it okay if I say, follow this carefully, is it okay if I say, because of the transfer pricing practice, the tax base in the country too will become narrow? I'll repeat it again. Is it okay if I say, because of the transfer pricing practice, the tax base in the country too will become narrow, or the tax base will shrink or become lower? Any confusion here? Any confusion, please do let me know. Why will the government change policy? If the government wants to earn more income taxes, they can bring agriculture sector and say, I'll impose a tax on it. There could be any reasons. Don't worry about reasons here. Understand the concept. Now, what is this what is this base erosion and profit shifting? Please go back to earlier picture only. Please have a look at the picture, and yes or not, whether you're understanding or not, please do let me know. The companies, when they follow transfer pricing practice, the tax base in country too will become narrow, will basically become smaller. Hence, I'll call this as base erosion. Hence, I will refer to this as base erosion. And why is the base, tax base eroding? Eroding means becoming smaller. Why is the tax base eroding? Because the companies are transferring profits from one country where the tax rate is higher to another country where the tax rate is lower. Is it okay? I'll repeat it. Follow this carefully. Once you understand, there is no difficulty in defining all of this. And please understand this. Before I go forward, I'll give you a point. Do not by heart definitions. This is my sincere suggestion to you people. Please do not by heart. Mug up. No, please don't mug up all the definitions. Certain definitions are very easy. First and foremost, what is tax base? Again, some of you are saying, sir, can't understand. Please follow the basics first. What do you mean by a tax base? It is an object on which government will impose a tax and collect the tax. If more and more incomes are earned by the people, let me have a look at whether you're understanding now or not. If people start earning more and more incomes in India, can you expect widening of the tax base? Is it okay? Right? Don't you think the tax base will widen because people are earning more taxes can be imposed and collected by the government? Simple logic. Now, have a look at this system. Companies are there in the second country. Tax rate is higher, and what the company is doing? It is transferring the profit from the country 2 to country 1. Transferring profits. Right? So, by transferring the profits, the tax base in the country 1 will erode. Erode means become smaller. So, there is a tax base erosion in the country 2 because there is a shift of the profits from one country with a higher tax rate to another country with a lower tax rate. This, in simple terms, is called as base erosion and profit shifting. And multinational enterprises, that is the companies which are established in multiple countries, are generally accused of following transfer pricing practice, transferring profits from one country to another country. I'll give you an example. Google is accused, or there is an allegation that Google pays very, very less taxes or no taxes in USA. And in fact, USA is its home country. I hope you understand. Google started in USA. Facebook started in USA. Apple started in USA. But despite starting in USA, which is their home country, their registered offices are in other countries. They're basically set up in countries where the tax rate is very, very low. And a country which offers a very, very low tax rate is called as a tax haven. Is it okay? A country which offers or which imposes very, very low tax rate, it is called as a tax haven. Any example for tax haven? Mauritius. Mauritius is a very, very famous tax haven. Have you heard of a place called as Panama? It is also tax haven. British Virgin Islands, Cayman Islands, all of these are nothing but tax havens itself. It is very easy to set up companies there, right? It is the tax rates applicable are very, very low in such countries. I'll give an example. If you set up a company in Mauritius, bring the money into India, invest in the Indian market, the long-term capital gains tax in Mauritius is 0%. I'll repeat it again, right? I'll repeat it again. If you basically have a company in, right, let's say Mauritius, earn certain capital gains tax, certain capital gains there, the long-term capital gains tax is 0% in Mauritius. In many of these countries, right, which are very, very small island nations like this, the corporate tax rate is 5%, 12%, 0%. These are generally referred to as tax havens. Done? Okay. So there is a lot of concern amongst all the developed countries as well as developing countries because the multinational enterprises are following base erosion and profit shifting. Now, next point is important. Follow this carefully. Because of the base erosion and profit shifting, developed countries are affected. Developing countries such as India are also affected. Now, is it okay if I say the base erosion and profit shifting is more a problem for a developing country compared to a developed country? Understand this carefully. The base erosion and profit shifting, it's a problem for all the countries, right, such as developed as well as developing. But it is much more or a much bigger problem for a developing country compared to a developed country. Sir, why? Simple. A developed country such as USA can generate revenues through multiple sources apart from taxes. Done? A developed country such as USA can generate money, can earn money through different sources. But what about a developing country such as India? In fact, if you look at the recently announced budget, 58% of the income that the government is earning is coming through taxation. And out of that, a substantial part of it is coming through corporate taxes. So if the companies in India will start avoiding taxes, don't you think it is much more a bigger problem for Indian government compared to USA government? Right? So remember that very carefully. And that is the precise reason all these countries have come together, developed as well as developing countries, and they have introduced a system which is called as BPS Action Plan. I hope you understand. All these countries, for example, India, USA, Britain, Japan, Germany, etc. All these countries have come together. They have proposed a system which is called as BPS Action Plan. And under this BPS Action Plan, there are totally 15 areas under which government has to implement reforms so as to reduce base erosion and profit shifting. Is it okay? I'll repeat it. Under the action plan, there are 15 points. Simple, 15 points are there. every government should implement reforms under these 15 points so as to reduce base erosion and profit shifting. And the idea of a base erosion and profit shifting initially was discussed by this group of countries, and the action plan was proposed by OECD as well as the G20. OECD stands for Organization for Economic Cooperation and Developed Countries, and G20 basically refers to group of 20 countries. India is a part of G20, by the way. Right, so this is the discussion regarding concept of base erosion and profit shifting. Is the logic okay? Can I go to the next reform? Very recently, there has been a discussion regarding GMCT, Global Minimum Corporate Tax Rate. Important. So far, UPSC has not touched this. Be very, very careful. Global Minimum Corporate Tax. Now, what is the idea of a Global Minimum Corporate Tax? Two very important points. We'll go one by one. First point. Imagine here is a country 1. Here is a country 2, C1 and C2. Country 1, right, I'm going by the first point. Understand these 2 points, then understanding 2 pillars will be very easy. In the country 1, let's say right now, the corporate tax rate is 20%, and second country corporate tax rate is just a hypothetical number, 21%. So not much of a difference in terms of corporate taxes. Now what if I say, second country now, the government will take a policy decision, rather than 21%, corporate tax rate will be reduced to 5%. Understand this very carefully. Either 5, 10, 15, doesn't matter. Much lower than 20%. That's very important. Now, earlier, the tax rate were almost similar. Now, in the second country or C2, corporate tax rate has been reduced. You tell me, don't you think because of this, more and more investments will start flowing from country 1 to country 2? Yes or no? More and more companies, not only from country 1, even from third country, fourth country, etc., etc., because they want to pay lower corporate taxes, don't you think more and more companies will start moving their offices, registered offices, into second country? Now, if country 2 is able to do that, why will the country 3 be quiet? What will the country 3 do? They will also bring down their corporate taxes, let's say, to 3%. Now, don't you think third country has become much more attractive destination? If C3 is going to do that, what do you think will C4 do? They will simply, right, say, I will reduce my corporate tax rate to 1%. Now, you tell me, is it okay if I characterize all of this and say it is nothing but race to the bottom? Let me know. All of this is basically leading to what? Race to the bottom. Every country is trying to undercut each other, thereby attracting a lot of investment. But as a result of this, what will happen? The countries will suffer. Why? They are not able to collect a higher amount of tax revenues. And all these countries want to spend money. So that is a concern. So first point is this. Please remember this. Second point, talk about India. Is it okay if I say the consumer base in India is very high? Right? Let me know if you disagree. The consumer base means what? How many customs are there in India? How many customers are there in India? Consumer base, right, for India is very, very high. A company such as Apple will come into India, provide certain services, earn a lot of profits from India. A company such as Google will come to India, provide a lot of services to us, earn a lot of income. But please understand this carefully, because the companies such as Facebook, Google, right, etc., because these are registered somewhere else where the tax rate is very, very low, they will use India's market, earn a very high amount of profit, they will pay the taxes somewhere else. Is it fair or unfair on India? Simple question, right? I'll repeat it again. these companies such as Apple, Google, Facebook, etc., they will use a large customer base of India, earn a lot of profit, but when it comes to the question of paying taxes on the sales, or let's say on the profits they have earned, they will pay the taxes in some other country. Why will the government of India be happy with that? Right? They should never be happy with that. They will simply say, customers are from India. You are generating profits because of them, but you are paying taxes somewhere else. Why should I allow it? That's a reason. Have a look at this. Now there is a system called as Global Minimum Corporate Tax. Global Minimum Corporate Tax. And have a look at this. Under Global Minimum Corporate Tax, India is one of the signatories, by the way. India has stated that we will implement these two. There are two very important themes or pillars. Pillar 1 and Pillar 2. In the context of Pillar 1, have a look at this. Right? Take India. A company such as Facebook will provide services, generate revenues from India. Now, part of the revenues or part of the profits which are generated because of this will have to be given to Government of India. Is it okay? I'll repeat it again. What is the first pillar? A company such as Facebook will generate a lot of revenues in India. Part of the revenues, basically part of the profits. So part of the profits which they have generated from India will be collected in the form of a tax by Government of India. Is it okay? Is the pillar 1 okay? Is it clear to you? So that I can go to the second pillar. The second pillar, much more interesting. In the second pillar, the multinational enterprises now will be imposed with at least 15% tax rate. Right? Will be imposed with at least 15% tax rate. So first point. My dear, right? How difficult is it? Just follow this carefully. Facebook is going to provide services in India, generate revenues in India. Part of the revenues will be collected by the Government of India because they are generating revenues in India. That is pillar 1. Right? So in whichever country you are generating revenues, same country will impose and collect a certain amount of taxes from you. That is pillar 1. Second pillar, right? Second pillar. The minimum corporate tax rate which is applicable on these companies should be at least 15%. Should be at least 15%. Now, how this will be implemented? Follow this very carefully. Do not be confused. We'll go step by step. Let's say here is USA. Right? My question to you before I start. In which country Apple started? Start answering. In which country Apple company started? In which country Facebook started? In which country, let's say, for that matter, let's say Google started? All of you agree it is USA? So I'll call this as home country. I will call this as home country. Right? Now it should be very clear why USA, I'm referring to it as a home country. But all of these companies are registered for payment of taxes in some other country. Let's say country 1, I will call this as a host country. Is the logic okay? What is the meaning of home country and host country? Home country is the country where the company is actually started. Host country is that country where they are actually registered for payment of taxes on their profits. And let's say hypothetically, in the host country, the corporate tax rate is 5%. And right, in case of USA, it is much higher than that. That's the only reason why they are set up in country 1. Now, as per the second pillar of the new plan, the tax rate imposed on these companies should be 15%, at least 15%. What do you mean by that? Let's assume a company such as Facebook, Amazon, etc. You can have hundreds of these companies. They are registered in country 1. They have generated profit of $100 million. Right? Simple numbers. They have generated a profit of $100 million. Now have a look at this very carefully. 5% of 100 million will be how much? Simple calculation, follow it. It will be $5 million. So Facebook company will pay the government of country 1 $5 million in the form of corporate taxes. But as per the latest policy, right, which is supposed to be implemented, the tax rate should not be 5, it should be at least 15%. It should be 15%. So now what the home country will do? What will the USA government do? The host country has implemented 5% taxes. Out of 15%, if you deduct 5%, how much is left out? 10% is left out. Facebook is present in USA. So the government of USA will impose 10% of 100 million, that is $10 million in the form of a tax and collect it from Facebook. Is it okay? Right? 15% should be the tax rate. They are paying only 5% in the host country. The difference between 15 and 5 is simply 10%. So 10% will be implemented on the profits earned by the Facebook, by the home country, and they will collect it. So in C1, the company will pay 5%. In the home country, they will pay 10%, thereby taking the corporate tax rate to 15%. So this is the second pillar. This is basically the second pillar. Now many of you will ask me, sir, why? What is the objective of second pillar? What is the objective? Objective is very simple. The companies are getting located in the tax haven so that the tax rates are very, very low. Now if I start either ways, if I start collecting 15% taxes from them, do you think there is any advantage of locating in a tax haven? They might start moving slowly and steadily into the home countries itself. That is the reason the second pillar of minimum corporate tax of 15% has been proposed. India, USA, along with more than 150 countries have accepted this. But we are yet to implement it. I hope you understand. It's a proposal. India has accepted, US has accepted, all of us have signed. But we are yet to implement this particular proposal of Global Minimum Corporate Tax, GMCT. Done. So this is one more methodology to address tax avoidance. Is the logic okay? Base erosion and profit shifting, addressing tax avoidance. Global minimum corporate tax, again to address tax avoidance itself. Now the third system which Government of India has implemented to address tax avoidance is a minimum alternate tax. Minimum alternate tax. Now before I start discussing minimum alternate tax, here is a very, very important point. I will show you the calculation. Please do not by heart calculation. UPSC doesn't ask calculations. That is point one. Second point, I will tell you there is a concept of a deduction. Simply accept it. Don't fight with me. Right? I know there are certain people from commerce background. I know they will basically have gone through all of these calculations. For them, they'll basically get it. Yes, right? They'll say, yes, it is correct. But other students who are from different backgrounds, don't worry about what is the provision in the Income Tax Act, what is the provision under the Corporate or Companies Act, etc. For all of this, simply take whatever I say as correct and move forward. Please don't waste your time. UPSC will not test you here. But let me explain to you what is the basic idea of a minimum alternate tax. Imagine here is a company X. The company has earned certain profits, but on the profits, company doesn't pay any tax to the government. Company pays 0 rupee tax to the government. Now these companies which do not pay any tax to the government are referred to as zero tax companies. Any difficulty in understanding what is the meaning of zero tax company? Let me know. Right? What do you mean by zero tax companies? There are companies which are making profits. But when it comes to paying taxes to the government, they are not paying any taxes to the government of India. Hence, government will call these companies as zero tax companies. Any difficulty? Can I go to the next point? Now, many of you will ask me, don't worry, how they do that? I'll tell you that. That is the point I'll explain. Many companies, now you'll ask me, sir, how is that possible? You are saying they're earning profit, but they're not paying taxes. How is that possible? Let me show you a very, very simple example. Imagine a company has earnings of 1,000 crore and expenditure done by the company is 800 crore. Now, for sake of understanding, can I basically call this 200 crore as a profit? Understand the logic here. For the sake of simplicity, can I call this as a profit? Now, what is the point? Next point is important. Follow this carefully. If you have listened to the lecture some time ago, I gave you an example of income taxes for you and me. And I said that if your salary is 5 lakh rupees, government will not impose a tax on directly 5 lakh rupees. Certain deductions will be allowed. And after that, government will impose taxes. Now, in the same way, do you think directly on 200 crore rupees, follow the statement and then answer. Do you think directly on 200 crore rupees, government should be imposing tax and collecting? Is it fair? Just think of it. Just like we are earning income, companies are also earning profit. They are spending money. They are earning more than expenditure in the form of revenue. So just like we are earning income, companies are earning profit. Is it fair for the government to directly impose taxes on their profits and directly start collecting taxes from them? It is not fair. It should not be done. It is not correct. Now, some of you will ask, sir, why? Why shouldn't government directly collect on 200 crore rupees? My dear, it is very, very simple. Imagine out of 200 crore rupees, I'll just give a very simple example. Imagine out of 200 crore rupees, you are paying certain, right, let's say, interest to the bank. Simple. You are paying certain interest to the bank. Now, don't you think on that 200 crore rupees, interest should not be imposed by the government? Taxes should not be imposed by the government. Right? So the argument is simple. Just understand this very carefully. Don't enter into provisions. So this is my sincere suggestion to you. Right? The provision simply says from the 200 crore rupees, deductions will be provided. Certain amount of deduction will be provided. For example, interest payment, dividend payment, right? A depreciation amount. All of these are right used or given as a deduction to the company. Now, here is an example of a company which has earned a profit of 200 crore rupee and is claiming deductions of 200 crore rupees, thereby reducing the taxable profits to 0 rupees. And if government of India will impose a tax rate of, let's say, 22 or 30%, doesn't matter, how much taxes will the government be able to collect? Government will simply collect a grand total of 0 rupees in the form of corporate tax. Now, is it okay if I say this company is nothing but a zero tax company? Start participating. Start participating. Is it okay if I say this company is basically an example of a zero tax company? Now, in the 1980s, there were multiple number of companies which could be classified as zero tax companies. Is it illegal to claim deduction? Is it illegal? Again, no. But by claiming deduction, huge amount of deductions like this, you will end up paying very, very less amount of a tax to government. Is it tax avoidance? Answer is simply yes. So have a look at this. During 1980s, Government of India realized that large number of companies are earning profits, but they are not paying the right amount of taxes to government. Right? And that is the precise reason in 1987, right, the Prime Minister, Mr. Rajiv Gandhi, announced a new system called as a minimum corporate tax, right? MCT. And later, the concept of a minimum corporate tax was restructured in 1996, and we started referring to this as a minimum alternate tax. Right now, the minimum alternate tax rate applicable is 15%. Some of the books I've checked it, you please update it. They say minimum alternate tax is 18% or 18.5%. Earlier it was 18, 18.5, etc. Now it has been reduced to simply 15% minimum alternate tax. Now many of you will ask me, sir, what do you mean by minimum alternate tax? Let me show you how the MAT will be implemented. Same example, nothing changes except one calculation. The company has earned 1000 crore. It has spent 800 crore. Now the profits of the company will be 200 crore rupees. Simple. The profits of the company will be 200 crore. And government says there are deductions allowed. You can claim the deduction. And after the deductions are claimed, whatever is the profits, whatever is a taxable profit, on this government will calculate 22% or 30%, whichever is applicable. Right now it has to be 22%. Sorry, it has to be, let's say 30%, right? Because the deductions are allowed only for these companies. So the company has claimed certain deductions. 30% corporate tax rate is calculated. And second step is, whatever are the profits reported by the company, on that government will calculate 15% tax. 15% tax. Between these two, whichever is greater, government will collect that as the corporate tax. Is it okay? I'll repeat it again. The calculation will remain the same. Only thing is that a new tax will be introduced. On the profits, government will calculate 15%. After claiming deductions, government will calculate 30%. Whichever is greater, government will collect that as a tax. This methodology is called as minimum alternate tax. Is there any difficulty in understanding this? Let me know. Right, so now some of you will simply say, sir, what is the objective here? Objective is simple. Government says you want to claim deductions, claim it. You want to pay 0 rupee tax as per 30% tax rate, right? Agreed. But what I will do is, because you are earning profits, I will also calculate 15% tax rate on your profits without deductions, without giving you any deductions. If let's say, if under step 1, the amount of tax is greater than the tax under the step 2, you will have to pay this amount as a tax to government. Right? Now, follow this carefully. Is it fair to say that minimum alternate tax has been implemented in order to basically reduce the incidences of the tax avoidance? Is it okay? Let me know. I'll repeat it again. The MAT as a concept, minimum alternate tax as a concept, has been implemented by the government in order to reduce the cases of tax avoidance. Now, even if you're a zero tax company, in fact, there are a large number of companies which can be classified in India as a zero tax company. Even if you're a zero tax company, you will end up paying certain amount of a tax to government of India thanks to minimum alternate tax, MAT. Is it okay? Can I go to the next one? If you are wondering about what we are discussing concept of a tax avoidance. Under tax avoidance, I am telling you what kind of reforms or steps have been taken in order to address tax avoidance. One is a base erosion and profit shifting. Second one is the concept of a minimum alternate tax. Third one is a global minimum corporate tax. Fourth one is an advanced pricing agreement. And there is one more important concept of a GAR, General Anti-Avoidance Rules. What is GAR? General Anti-Avoidance Rules. This is the long form of GAR. General Anti-Avoidance Rules. Now, right, what is the system of GAR? I'll come back to this slide, don't worry. Have a look at the calculation. Now, before I start, don't have a heart attack, don't have a panic attack as well. You don't have to by heart this nor this. I just want to just show it to you how GAR is actually implemented. UPSC will not ask you the calculation. Trust me on this. Do not by heart it. But let me give you a glimpse of how companies actually operate. How do they try to avoid taxes? Let me show it to you. Right, have a look at this. Here is a country which is a tax haven. I'll call this as country 1 and I'll call this as country 2. Imagine you are the owner of company ABC. Imagine you are the owner of company ABC. Now let's start. You will go to a tax haven, set up one company there. You will set up one more company within, right, let's say India. XYZ will be set up in India and DEF will be set up in the first country, which is a tax haven. So why are we setting up two companies like this in two different countries? Simple. You want to reduce the taxes. You want to pay lesser taxes as much as possible to the government of India in this context. Now, after setting up two companies, what you will do is, your company XYZ will take a loan from company DEF. Is the point too clear? We are going one by one. Step 1, you will set up two companies, one in a tax haven and second one in India. Step 2, the company which is set up in India will take a loan or will borrow from company DEF which is set up in a tax haven. Why, you will understand in a minute. If you remember some time ago itself, I told you certain amount of deductions are allowed for companies, such as you have taken a loan, on that you pay interest. Is it okay? I'll repeat it. Certain amount of deductions are allowed for the companies, such as the loan that you have taken, and if you pay interest on the loan, you can use it as a deduction. Now, question to you, just think of it. Just think of this and answer. Is it okay if I say, if you start claiming higher and higher interest, if you start paying higher and higher interest on the loan, the amount on which you will pay taxes will come down? I'll repeat it, right? Just think of this and answer to me. If you take a loan and pay interest, automatically interest will be deducted. Now, if you pay higher amount of interest, don't you think the amount of deduction will be higher and the amount on which you will pay taxes to government will be lower? And as a result of this, you will pay lesser taxes to government of India. Is it clear or not? Let me know. Is it clear or not? Now, follow the next step. That is step number 3. Let me go to point number 4. This is very technical. Follow this. You have set up a company XYZ. You have set up a company XYZ and right, you have taken a loan. You have taken a loan. Now, because you have taken a loan, you will start paying interest on it. You'll start paying interest on it and you will start claiming that interest as a deduction. Start claiming that as a deduction. Now, to address this issue itself, now what is the issue here? Because you have taken a loan from a related company which is set up outside India, you will take a loan, pay interest, company DEF has started earning more and more profits. Is it okay? Company DEF has started earning more and more profits and they will pay taxes in a tax haven where, let's say, tax rate is 0%. Tax rate is simply 0%. Now follow the next step carefully. You will go to the tax officials here in India and you will file, right, the returns in India. And you'll simply say, let's take a simple number. You have earned a profit of 1000 rupee and the interest that you have paid on the loan is 100 rupee. So the amount of profits on which taxes can be imposed is 900 rupee. 900 rupee. Now understand this carefully. If the tax rate is 30% on 900 rupee, how much taxes you will end up paying to the government? 270 rupees. Now what the tax authorities will try to find out, follow the point here. What the tax authorities will try to find out is from where you have taken the loan, from which institution, from whom you have taken the loan. And if they find out that you have taken a loan from a related company, that's very important. What is the related company? Who is the owner of DEF? Who is the owner of XYZ? You are the owner. Same owner. Don't you think both the companies, though they are set up in two different countries, are related to each other? So if the tax authority finds out that you have taken a loan from a related company which is set up outside India, and you are claiming the interest that you have paid on such loan as a deduction, the tax authority will not allow you to claim it as a deduction. I hope you understand. Many of you ask me, sir, why? If I've taken a loan, I'm paying interest on it, I should be given that deduction. Why is the authority not giving it to me? Simple, both are related companies. Both DEF as well as XYZ are related companies. You are basically taking a loan from a related company so that your tax liability will come down. You could have taken the loan from anybody else in the market. Why specifically from DEF? That is also the one which is set up in a tax haven. What is the objective? Why did you take it? The objective was simple, so that you will claim it as a deduction and you will pay lesser taxes to Government of India. Such transactions are called as impermissible avoidance agreement. Is it okay? Such transactions are referred to as impermissible avoidance agreement. Now there is a very interesting question. How will they come to know? My dear, you will have to submit all of these documents. I hope you understand. Many of the times I keep on getting these questions. How will they come to know? How this fellow will come to know? You will have to submit all of these. For example, if you're an income taxpayer, can you simply tell the Government of India, I've earned income 2 lakh rupees. That's it. Do you think that is how the system will work? Right? Do you think how this is how income tax is collected? No, my dear. You will have to submit a lot of documentation to Government of India. You'll have to submit proof saying that you have earned only 5 lakh. You'll have to submit a proof saying that you have invested in the PPF. You have invested in the NPS. You have taken a loan. You'll have to submit a lot of documentation. It's not on word of mouth. You cannot simply tell government, this is the tax, take it. No, lot of documentation is involved here. Okay, so understand this carefully. If you are the tax official under the new system, you will come across the documents given by company XYZ. You will now come to know that, right, they have taken a loan from DEF and the interest that they have paid, they are claiming it as a deduction. And now what you will do? Under the concept of GAR, General Anti-Avoidance Rules. Look at the last word here. General Anti-Avoidance Rules. What do you mean by rules? These are nothing but set of guidelines. Is it okay? These are nothing but set of guidelines. These are nothing but set of guidelines which you can use either to allow for certain transactions to be used for claiming deductions, or you can simply say these transactions were conducted only with the objective of reducing taxation. You wanted to pay lesser taxes, hence you have conducted these transactions, so I will not allow you these deductions. So have a look at the system here. Under the concept of GAR, what you can do as a tax official is simple. The company will come, they will submit the documents and they'll say, sir, look at the transactions, I will pay 270 rupee tax. Now as a tax official, you will look at it and say, because you have taken a loan from a related company, that will reduce your tax liability, I will not allow this as a deduction. I will not allow this. So rather than paying taxes on 900 rupee profit, now you'll have to pay taxes on 1000 rupee profit itself. So 30% of 1000 rupee, you will be asked to pay 300 rupee in the form of taxation. So without GAR, government will be collecting 270, and under the GAR, avoidance will be addressed and the government will be able to collect 300 rupee taxes. A simple question to all of you. Is it okay if I say GAR will be used to address tax avoidance in the economy? Don't by heart the calculations. Please do not by heart the calculation. Right? Simple question. Will the GAR concept be used to address avoidance in the economy or not? There is one interesting question. That's the reason I keep on telling you, please listen to the discussion first. Listen to the discussion first. The question is, sir, MAT is already there. My dear, MAT simply calculates 15% of the profit and 30% of the profit after deduction. Did I discuss anything under MAT related to whether the transactions are allowed or not allowed? Did I say deductions are allowed or not allowed? The MAT doesn't address it. MAT simply says 15% of the profit or 30% of the profit after deduction. Whichever is greater, you collect it or you pay it in the form of taxation. But under GAR, what we are trying to do? Certain transactions are conducted. We want to decide whether the transactions can be used for reducing the taxation or not. That will be decided under the concept of general anti-avoidance rules. Done. So this is the discussion related to many measures which have been taken by the government in order to address the tax avoidance measures in the economy. So please be very, very careful. Questions can be asked by UPSC related to this. Do not write the calculations. Trust me, UPSC will not ask you the calculations. Can I go to the next one? Any concern so far? Can I go to the next one? Sir, calculation under the MAT will always be greater. Not necessarily. Right? There's a question, sir, under the second one, it will always be greater. No. Right? Step 2 is always smaller than the step 1. Not necessary, my dear. It is not always so. Right? Why do you always take this as a sacrosanct? If that was always the correct one, why do you think this system was introduced? Imagine a company has a profit of, let's say, 200 crore. On this, 15% is calculated. On this is 15% is calculated. Deduction of 50 crore will be claimed and the company will have a profit of 150 crore rupees. Now calculate 30% on this. Use a CSAT knowledge. Use a CSAT knowledge. Right? Or take up your mobile phone, start calculating. 15% of 200 is how much? 30 crore rupees. 30% of 150 crore is 45 crore rupees. Now tell me which one will be collected by the government? 45 crore rupees will be collected by the government. It's not necessary that always the lower one will be smaller and the first one will be larger. No. This has been done in order to ensure that zero tax companies will not scot-free or will not be running away without paying any taxes. Done? So this is the discussion regarding many of the types of reforms that the government of India has implemented in order to address tax avoidance in India. Done? Shall we go to the next one? GST. Very, very important. If you're reading the newspaper every day, this is there in the newspaper. Even in today's newspaper, there is a mention regarding the GST. That is specifically talking about compensation, etc. Now, before I start GST, let's take a small break. I'll start the session. Or before that, let me address your questions. What is the corporate tax in Singapore and a safe haven countries? It will vary from one country to another country. You don't have to by heart the list. Right? There is a huge variation. Some countries have 0, some countries have 12.5, some countries have 7, etc., etc. Sir, what will happen after sold and the amount is lesser than the purchase? My dear, if you purchase a land at, let's say, 2 crore, you sell it at 1 crore rupees, it is called as a capital loss. Simple. If you purchase an asset and sell it at a lower price, it is a capital loss, not a capital gain. Now, if you have a capital loss, what do you think is preferable, right? Do you want to pay taxes even when you incur losses, right? So obviously, if you are going to incur losses, right, the government is not going to impose taxes on you. Done. So let's take a break then, right? So I'll restart the session at 1:50. I'll restart the session at 1:50. Let's start. Let's start. So before I start, there's a question: is economics part of GS paper in the mains? Yes, right. In the GS paper 3, uh, economics is a part of it. In fact, one of the very important part of UPSC examination. Will it be calculative? No. And that's the reason I keep on telling the students. For you also, I'd give a very important reminder. Whatever calculations I've done in the slides, it is only for your purposes. If you understand it, good. No use in the UPSC to write the calculation. If you do not understand, leave it. Leave it. Don't basically try to by heart the calculations. UPSC doesn't ask you the calculations. Done. So let me start with the GST now. Very, very important for UPSC. Concept of goods and services taxation. Okay, goods and services tax. Now, first point, GST. Any doubt when I say GST is an indirect tax? Anybody here who says, right, why it is an indirect tax? Please do let me know. Last week itself we have discussed GST is an indirect tax. What do you mean by indirect tax? Where the tax burden can be transferred. Simple. Whenever the tax burden can be transferred, it is called as an indirect tax. For example, the government says hotel has to pay GST to the government of India. But the hotel, they will simply transfer means they will collect the tax when you go to the hotel or a restaurant, right? That is basically the concept of transfer of taxes. So GST is an indirect tax. Now let me start here, right? Follow this very carefully. If you can understand these concepts, GST is very, very easy. First one, earlier there was a cascading effect in the economy. Before GST, there was a cascading effect in the economy. What do you mean by a cascading effect? Whenever a tax is imposed on an existing tax, it is called as cascading effect. Let me explain to you with an example. A will manufacture something, sell it to B. B will manufacture it, sell it to C. Right? Step 1, step 2. I'll write it so that you have a doubt. Please tell me in which step you have the doubt. So in the step 1, A has purchased something, or let's say A has manufactured a product, will sell it at 100 rupee to B. And imagine the tax rate applicable is 10%. Obviously, B will pay how much? 110 rupee, including 10 rupee tax. Now, B has purchased it, will add certain value. That is, labor will be added, profit will be added, etc., etc. B wants to sell it to C at 130 rupees. And remember this, out of 130 rupees, there is already a component of 10 rupee tax, which is already paid. Now, if I calculate 10% on 130, which is nothing but 130 rupees plus 13 rupees, and if C will purchase the product at 143, simple question to you, is it not tax on a tax? When I do this calculation, is it not tax on a tax? Please answer the questions. Is it not a tax on tax? So that I will go forward. Otherwise, there is no point in doing all of this exercise if I don't know whether you are understanding or not. So when the government will impose tax in the step 2 again on 130 rupees, 130 rupee already includes a 10 rupee tax. It is nothing but a tax on a tax. So whenever there is a tax on tax, this is called as a cascading effect. Doubt solved? This is nothing but cascading effect. And what is the problem with the cascading effect? One, the market prices of the goods are higher. Market prices are higher. Second, the tax burden on C is also higher. The tax burden on the customer, if you are the customer C, the taxes that you are paying are very, very high. Sir, how the tax burden is very high? If I simply break the 143 rupees, break it into different components, can I write it like this? 100 rupee is the actual cost of the raw material, plus 10 rupee is a tax. Then in the second step, B has added 20 rupee profit, and again 13 rupee is a tax. So total is 143. But have a look at this. In the first step, 10 rupee tax is there. Second step, 13 rupee tax is there. Don't you think the taxes that are paid by the customer are very high? Second point. Third very important point, imagine you are an exporter. Imagine you are an exporter. Now, don't you think because of the cascading effect, the prices on the good are very high, exports competitiveness will go down? Right, let me know. Because of the cascading effect, the price of the product will increase, and as a result of this, the competitiveness of exports will go down. What do you mean by competitiveness? Simple. China is exporting the product. You are also exporting the product. In China, let's say it is 140 rupees. You are exporting, it is 143 rupees. So you tell me, another country, let's say USA, will they import more from you or will they prefer Chinese products? They will end up preferring Chinese products. So export competitiveness will come down. All the 3 points are clear? All the 3 points are clear. What are the 3 points? One, higher tax burden on the customer. Second, market prices will be very, very high. And the third one, export competitiveness would be affected. Right? So this is a problem with the cascading effect. And there was a cascading effect earlier, because please understand this. The government earlier at the central level, remember this, at the central level, government earlier had an excise duty. Government had excise duty. Excise duty means tax on production. Simple. Excise duty was imposed, a tax on production. And at the state level, the state government had sales tax. The state government had sales tax. That is, when the product will be sold, the government used to impose a sales tax. Now you will ask me, sir, what is this excise? What is this sales? Simple. Whenever the final goods are manufactured and sold in the market, state government used to impose a sales tax. And whenever raw material was imposed, the central government, whenever the raw material was sold, the central government would impose excise duty. It should be very clear. Whenever the raw material was being sold in the market, basically for production purposes, excise duty was imposed. Whenever the final good was sold for consumers in the market, sales tax was imposed and collected by the state government. Sir, why? Why two different types of taxes? Constitution of India. Simple. Constitution of India under Schedule 7, has divided the taxation powers between the center as well as the state like this. Now, have a look at this very carefully. Imagine I will purchase raw material. I will pay excise duty to the government. Now, I will manufacture the pen, right? I will include the excise duty that I've paid in the price of the pen. I'm about to sell it to you. State government will impose a sales tax. Now, is it not cascading effect? I'll repeat the process. Follow this carefully. I will purchase raw material to manufacture the bottle or let's say pen. I've paid what? Excise duty to the central government. Now I've manufactured the bottle. I want to sell it to you at 110 rupees. State government will impose a sales tax because this is a final good. Final good, sales tax is imposed. On what? On 110 rupee. 110 already includes the central government taxes. So simple question to you people, is it not leading to cascading effect? So earlier this used to happen, right? Lot of issues in the cascading effect. So what we did was, the state governments now decided, let's replace the concept of sales tax. Let's introduce a new system called as value added tax. Follow this very carefully. That state governments decided, let's replace the concept of sales tax because it is leading to cascading effect in the market. And in the place of sales tax, let's introduce value added tax, VAT. Now, how VAT proposal was different compared to earlier system? Follow the process carefully. Again, I'll write step 1 and step 2. Let's start. Step 1, I will purchase something, manufacture, or let's say rather than purchasing, I will manufacture something, sell it to you. And government has imposed a tax of 10%. So 100 rupee plus 10 rupee, 110. Step 1 doesn't change, remains the same. But look at the step 2. Now you will purchase the product from me, right? Let's say manufacture a product, sell it in the market. Now follow this very carefully. Earlier, what used to happen? You will take 100 rupee plus 10 rupee. Why 100 plus 10? 100 is basically the cost of the product. 10 rupee is the price, 10 rupee is the taxes that you have paid to the government. Now what government says is, under the VAT system, I repeat, under the VAT system, whatever taxes you have paid to the government will be given back to you. I repeat, under the VAT system, whatever taxes you have paid to the government will be given back to you. Meaning what? When you purchase a product, you have paid, let's say, 10 rupee tax to the government. Government says, I will give it back to you. Now, simple question to you people. If you have paid 10 rupee to the government and government will give it back to you, will you keep on adding that in the market price? Just think of this and answer. I'm saying you have purchased the product and you have paid a tax on it. Government says they will give it back to you. And now you want to sell a product in the market. Will you keep on adding the taxes in the market price? You should not add it. Why? You will get the 10 rupee back from the government. Simple. When you're getting the 10 rupee back from the government, why will you add it again? That will again lead to cascading effect. So what will happen in the step 2 is 100 rupee as it is, because that is the cost. 10 rupee you will get it back, so you will not add 10 rupee now. 20 rupee cost of labor, profit, etc., etc. So now the selling price will be 120 rupees. Now the selling price will be 120 rupees. Now on 120 rupees, imagine again a tax of 10% is imposed. On 120, tax of 10% is imposed. Simple question to you, is it a tax on tax? Follow this carefully. Second step, 100 rupee plus 20 rupee. On this, a 10% tax is imposed. Is it a tax on tax? Right? Answer is no. Because 120 rupee, where is the tax in 120? There's absolutely no tax in 120. So it is not tax on a tax. Is it okay if I put it in another statement? There is no cascading effect here. There is no cascading effect in this particular process. This was the beauty of VAT system. Under value added taxation, understand this, under value added taxation, which was introduced by the state governments, they basically stated at every step, whatever taxes you pay will be given back to you, will be refunded to you. Rather than using the term refunded, they will use the term credited back. Credited back means what? You will have an account with the tax department. This 10 rupee will be transferred into your account. Right? Will be credited back to you. And because you are getting the taxes that you have paid on the inputs back, you will not simply transfer, you will not add it in the selling price. And that will basically eliminate the issue of cascading effect. So far so good? Again, what is credit? Credit means adding, my dear. Please, my only concern is every terminology you don't have to understand, let's say, the meaning of it. And some of them are basically self-explanatory. What is credit? Credit is addition. Salary is credited into your account. It is not debited from your account. So have a look at this simple process. Don't by heart the numbers. Simple. You will purchase a product from me. You will pay 10 rupee tax to me. I will give it to government. Let's go step by step. Right? At least tell me now whether this is clear or not. Step 1, I will sell something to you. You will give me 100 rupee plus 10 rupee. That 10 rupee is a tax. Do I keep that 10 rupee? No, that is a tax. Tax should be given to government. So government will get the 10 rupee from me. Now you have purchased something. You will use labor. You want a profit. So rather than taking 100 plus 10, you will not count the 10 rupee tax. Why? I have taken the 10 rupee tax, given it to government. Government will give it back to you. Simple. Government will give it to you. So if government is giving it to you, why will you count it? Right? Why will you simply count it? Why will you transfer it to customer? So you will simply count 100 rupee. 100 rupee plus labor cost plus profit. Now you want to sell it at 120 rupees in the market. Government will again impose 10% tax on 120, because out of 120 there is no taxation. Out of 120 rupees there is no taxes there. It is not going to have a cascading effect. Right? This concept was introduced. Right? This concept was introduced under the concept of value added taxation. This concept was introduced under the concept of value added taxation. Now again, don't try to find out loopholes in the whole system. I'll tell you, there is a loophole. I'll tell you that. Sorry, if they are giving it back, why they are collecting? My dear, how government will come to know whether you are in the system or not? You tell me. And you want to find out everything? No, you tell me. How will government of India find out whether you are there in the system or not? Right? Again, my only concern is you people don't focus on what is relevant. You try to focus on what is not relevant. Right? So understand, government wants to know how many companies are there. Government wants to know what is the actual cost at which you are selling to, right, company B. Whether company B is calculating the profits and reporting them correctly or not. If nothing, no data is available to the government, how will the government give you 10 rupee back? You tell me. Right? So again, don't try to find out, right, sir, how will I get the credit, right? You tell me. Very simple question to you people. Right? And in fact, I've told you in the last week also. Open up last 5 years question papers. Please check the kind of questions UPSC will ask. You want to become accountant. That is not the requirement of UPSC. Some of you may not like my statement, but that's a fact. You want to become accountants. Not required for UPSC. Nowhere UPSC is going to ask you, if I give you 100 rupee, tell me at 10% tax, how much will be my input tax? How much will be my input tax credit, etc. Please don't waste your time. Okay, now let me go ahead. Right, let me go ahead here. Follow this next point carefully. The taxes that you paid on the inputs, which are credited back to you, it is called as input tax credit. Is it okay? Right, I'll repeat it again. The taxes that you pay on the inputs, which are credited back to you, that is called as input tax credit. ITC. Is the concept clear here? Why there was a cascading effect earlier? And that's the reason the state governments shifted to VAT system, where whatever taxes were paid when they purchased inputs were credited back. Input tax credit system was introduced, and as a result of this, cascading effect was addressed. Shall I go to the next one here? Shall I go to the next one? Let me know, yes or no. Again the same question. If government is going to credit back, why impose? My dear, when I explain it, I don't know where you people listen to or what you people listen to. I've addressed that question. And don't keep on asking the same thing again and again. No point in telling the same thing again and again. Okay? Now, VAT system on the paper looks very perfect. That is, whenever input taxes are imposed, you will get the credit of it. So, looks a very, very good system. No issue. Cascading effect would be addressed. But there is a problem with the VAT system. Follow this concept very carefully. There is one problem, very big problem with the VAT system. What is the big problem? Let's imagine you are manufacturing in state 1, I am purchasing, but I am from state 2. Right? Follow this very carefully. If you miss it, you will not understand. Right? So follow this. You are a manufacturer in state 1. I will purchase from you state 2. I am in second state. I will produce another good. I will sell it to a consumer in the third state. Okay? Or let's say in the same second state. Now, first point. If you are manufacturing in state 1, is it okay if I say VAT comes under respective state governments? We'll go one by one. Follow this carefully. VAT comes under respective state governments. Is the point clear? Right? Is the point clear? Right? Because the argument is earlier sales tax was there. States removed sales tax, introduced VAT system. So under VAT of one state, imagine you are manufacturing in state 1. Don't you think you are registered with the state government of state 1? I am manufacturing in state 2. I am registered to the second state. Point number 2. Is the second point clear? Is the second point clear? I'll go to the third point now. Thanks. Let me go to the third point. Now imagine you will manufacture a product. You will sell the product across the state border. You will sell it to me. I am sitting in the state 2. And this is where the problem will start with the VAT system. Follow this carefully. Now, whenever you are there in the same state, the state government can impose and collect taxes. Right? Point is very clear. Whenever you are manufacturing and selling it within the same state government has the right to impose and collect the tax. As per the Constitution of India, whenever the goods are moving from one state to another state, state governments don't have the power, central government has the power. I repeat, as per the Constitution, whenever you talk about interstate trade and commerce, interstate means what? Between two different states. Whenever you're talking about interstate trade and commerce, it is not the state government that will have the right to impose taxes. Rather, it is the central government which will impose the taxes. Is the point clear here? Now, some of you will say, sir, no, state government should impose taxes. Then my question will be, which state government? If state government imposes taxes, what the state government or second state do? Right? If state 2 is imposing taxes, what the state 1 will do then? So that is the reason interstate trade and commerce. Remember the term. It is the central government which will impose taxes. Now the tax that was imposed by the government of India was a Central Sales Tax. CST. Central Sales Tax. And this is very peculiar tax. Remember this carefully. Earlier, Central Sales Tax was there. Today, no, it is GST. I'll come to that later. So, whenever interstate trade and commerce took place, central government imposed Central Sales Tax, but it was collected by the state government where the production happened. I'll repeat it. It was imposed and collected by the state government where the production happened. Look at this picture. A is manufacturing a product, selling it to B across the state border. Across the state border. Central sales tax is applicable. Don't ask me, sir, why VAT is not applicable. My dear, because it is moving from one state to another state. VAT is not applicable. Central sales tax is applicable. Now, the central sales tax will be imposed and collected by the state where manufacturing has happened. Manufacturing has happened where? In state 1. I'll take simple numbers. 100 rupees is the selling price. Let's say central sales tax is 10%. It will go to which state? State government 1. Now, I have purchased that product from you. I want to sell it to a consumer in the same state, that is the second state where I am there. I will basically calculate like this. The cost of the product for me is 100. tax is 10 rupee, I want to earn a 20 rupee profit. Now here comes the difficulty. If I count this particular 10 rupee, that will lead to what? Cascading effect. Is it okay? That will lead to what? Cascading effect. But if I don't want to count it, somebody has to provide the tax credit to me. Is the logic okay? Right? If I count the 10 rupee and sell it, it will lead to cascading effect. But if I don't count it, I've paid the 10 rupee from my pocket. Somebody has to give it to me. Now the question arises, who will give the 10 rupee to me? The problem is, I am registered with the state 2. They have not collected 10 rupee. State 1, which has collected 10 rupee, I am not present in that state. So follow this, right? Follow the problem here. I am registered with the second state. I will ask the second state government, please give me 10 rupee credit. Second state government says, I have not collected the money from you. Right? I will go to the state government 1, ask for the 10 rupee credit. They will tell me, I am not registered with them. So the fact of the matter is, I will not get the tax credit of 10 rupee. And as a result of this, right, have a look at this. As a result of this, my selling price will be how much? 130 rupees. I want to sell the product now in the second state. Automatically, the government in the second state will impose a tax on 130 rupees, that is 10% of 130. As a result of this, there is cascading effect in the system. As a result of this, there is a cascading effect in the system. Now, is the system okay with you people? Right? Is it okay? Why VAT system, despite trying to address, the idea of a VAT was introduced to address cascading effect only. But because of the interstate trade and commerce, even though VAT was there, there was a cascading effect. Right? Any problem with this? Any problem? Shall I go to the next one? Can I go to the next one? Let me know. When I say, can I go to the next one? Your answer should be either yes, right, or okay, or anything is okay, rather than saying, no, don't go to next one. If we say, no, don't go to the next one, what should I do? I'll keep looking at you like this. You will keep looking at me, or I'll keep looking at you. Right? Of course, you are looking at me and you will simply say what this fellow is doing. I cannot look at you people. Right? So if I ask you whether this is okay, shall I go to the next one? If you have a doubt, please let me know, so that I'll explain and go forward, rather than simply sitting quiet. Okay. Sir, government is returning, why it is imposing? For the fourth time. I'll repeat it for the fourth time. How will government come to know how many companies are there in the economy? How will government come to know how much profit you are earning? How will government come to know, right, what goods you are manufacturing, selling, the prices of them are fair, unfair, correct, wrong, etc. You tell me, how will government basically count every producer in the economy? Please do let me know. Right, so basically it has been implemented in order to ensure that there is a concept of accountability in the system. Okay, VAT is good or bad? Again, there is no state answer to that. There is absolutely no state answer. VAT was implemented in order to address the cascading effect. But despite having a VAT system, there is a cascading effect thanks to the central sales tax. Okay. Okay, now before I go forward, here is a very important point. There are two types of taxes, right? Understand this carefully. One is called as a production tax, and the other one is called as a consumption tax. Production tax and consumption tax, or else they will also use a term origin-based taxation and right, origin-based taxation and destination-based taxation. Now, you don't have to get into the details of it. Simple concept. If the tax is imposed and collected by the state where production has taken place, that is called as origin-based taxation. I'll repeat it. The tax is imposed and collected in a state where the production has taken place. That is called as an origin-based taxation or production-based taxation. And if the tax is collected where the consumption of the goods has happened, that is called as a consumption-based taxation or a destination-based taxation. Are the words clear for you? I'll repeat it. Where the goods is produced, and if that state will impose and collect the tax, that is called as a production-based taxation. And if the good is produced and consumed somewhere else, and the state where consumption has happened, that state will collect the tax, that is called as a destination-based taxation. Now, simple question to you people, tell me, what is the central sales tax? What is the central sales tax? The central sales tax, it is a origin-based taxation or a consumption-based taxation. Is it a taxation that is origin-based or destination-based? Right answer is, thanks a lot, both. How, my dear? How? Right? How CST is both? Right? Basically, then you have not understood what I've told you so far. Central sales tax is origin-based taxation. It is origin-based taxation because it is imposed and collected by the state government where production has happened. Where production has happened. And you cannot simply say, sir, what if the production as consumption has happened in the same state? Then, my dear, central sales tax is not applicable. Don't try to create problems where there are no problems. Right? Some of you will simply say, sir, how? If the good is produced in the same state, consumed in the same state, don't you think central sales tax will become consumption-based taxation? In that case, if the good is produced and consumed in the same state, central sales tax is not applicable in the first place. Central sales tax will only come into picture when the good is moving from one state to another state. And that is very, very important. Remember this. Don't try to create problems where there are no problems. Okay. So the issue with interstate sales and trade was the taxes were multiple, right? More taxes were there, cascading effect was there, etc. Okay. Right. So these were some of the issues. In fact, this slide is wrong. I don't know why he has put this slide. It is not interstate sales. It is actually GST. I'll ask him to change it. Don't worry. It is GST. So understand this. There were issues related to VAT system. All of you will agree? There were issues. VAT was an improvement over earlier system, but even the VAT system had certain issues. Now, in order to address right the VAT system or the flaws of the indirect taxation system, we have introduced GST, Goods and Services Tax. Now, why GST has been implemented? In order to address cascading effect. There were multiple indirect taxes. For example, have a look at this. Central government had multiple indirect taxes. State government also had multiple indirect taxes. Now just think of this and answer. Imagine you're a manufacturer and you're selling in large number of states. Don't you think multiple indirect taxation imposed by the center as well as the state will make it difficult for you to conduct business in India? I'll repeat it again. Right? Imagine you are a mobile manufacturer and a seller in India. One state will impose a tax of 5%, another state 12%. Central government will also have a lot of these indirect taxes, service tax, that tax, this tax, etc. Is it easier to conduct business or difficult to conduct business in such an environment? Answer is latter. It is hard. It is difficult to conduct business. Now, what if I were to say, rather than this, I will simplify the whole indirect taxes and I will impose only one tax on you now, GST. Whether you are manufacturing, you are selling, whether you are a service supplier within the same state, across the state, doesn't matter. Only one tax, that is a GST. Now, can I conclude and say that with introduction of GST, it will make it easier to conduct business in India? Is it okay? It is basically one of the reforms that has been implemented by the government to promote ease of doing business. Ease of doing business simply refers to policies of the government which makes it very easy for the businesses to conduct operations in India. So GST will address cascading effect, what type of taxes have been subsumed, etc. I will give the list, have patience. Second, there are multiple indirect taxes earlier. Now only one indirect tax, that is a GST. Earlier, because of that, it was slightly difficult to conduct business. Now it is easier to conduct business. Now the next point, with the introduction of GST, it will lead to widening of the tax base. Is the logic okay? More and more businesses are brought under this. More and more goods are brought under this. Services are brought under this. Don't you think that will lead to widening of the tax base? And that's also a fact. Remember this. Next one is the cost of transportation is a problem. It will be addressed. The cost of transportation is a problem in India. It will be addressed. Now many of you will ask me, how, sir? How transportation cost is right basically connected to GST? Simple. Follow this carefully. Until recently, that is before the introduction of GST, if you wanted to move the goods from one state to another state, right? Have a look at this. If you wanted to move the goods from one state to another state, at the border, you will stop the truck. And there will be an official. You will have to go to the official, show the documents to the official, pay the amount of the taxes, and you will be allowed to move from one state to another state. Now, simple question to you. With this policy that we had implemented, or the practice that we had implemented, don't you think the time taken for transportation would be higher? I hope you understand. Don't you think the time taken for transportation would be increasing? And if the time taken for transportation increases, what do you think will happen to cost of transportation? Right? Don't you think time taken will also lead to higher cost of transportation? Right? So that was one of the problems. Now, many of you will ask me, sir, how GST has basically addressed this issue? Simple. Under GST, whenever you are moving from one state to another state, you don't have to stop at the checkpost. Simple. I'll repeat it. Under GST, you don't have to stop at the checkpost. At the border, you don't have to stop. Now, right, start answering. If you do not have to stop at the borders, what will happen to time taken for transportation? Time taken for transportation will come down. Agreed? It will come down. And right, have a look at this. If time taken for transportation will come down, right, don't you think cost of transportation will also be addressed? Right, the time taken, the cost, etc. automatically will come down. That is how GST will basically contribute to promotion of logistics sector in India. Is it okay? It will contribute to the growth of logistics sector. Sir, what if they are doing smuggling? My dear, in any case, right, if they are doing smuggling, GST is not for doing or addressing the issue of smuggling. Right, so the objective is simple. Cost of transportation will also be addressed. Now, these are some of the very important objectives. Have a look at the data given by the government. As per the data given by the government, basically out of the total time for transportation, 40% of the time was actually used for transportation purposes. At the checkpost, the trucks were spending 25% of the time, and other stoppages, right, basically consumed around 35% of the time. Meaning what? Imagine you are moving the good from A to B. You are moving the good from A to B across different states, and let's say you consumed 4 days for it. One of the day you actually spent at the checkpost. Simple. One day out of 4 days you will spend at the checkpost. What checkpost do? My dear, again, just follow what I'm discussing. I told you this. You will get down at the checkpost. You will take all the documents, go to the authorities, show the documentation, come back, right, move your truck. after getting the approval. That is the, right, let's say, function of a check post. Now the time consumed was higher, cost also higher. You will reduce the cost by eliminating check post. Under GST, there is no check post system now. We have eliminated the check post system. So this is how GST will be contributing to logistics sector. Now what are the other important features of GST? Let's go one by one. It will subsume the indirect taxes and lead to a system of one nation, one indirect tax. I'll repeat it again. Right? It will basically subsume means what? Basically bring all the indirect taxes under one system, one tax, that is goods and services tax. It will subsume all these indirect taxes and it will lead to the theme of the GST, one nation, one indirect tax. And earlier, I hope remember, as per the Constitution of India, the taxation powers are divided between center and state. A simple question to you, if I'm implementing GST, don't you think first you need to make changes in the Constitution? Just think of it. Constitution of India says the indirect taxes, some of them I will give it to state government. Some of them are given to central government. Now under GST, if I'm going to bring all these, right, the indirect taxes under only one tax, don't you want to amend the Constitution? Don't you want to change the provisions in the Constitution? Answer is simply yes. So 122nd Constitutional Amendment Bill. Constitutional Amendment Bill. Please understand, some of you are telling me, trying to correct me. Sir, it is not 122nd, it is 101st Constitutional Amendment Act. The point that you people are missing is, I have written bill here, you are mentioning act. So I'm pretty sure you can understand what is the difference between both. So government introduced 122nd CAB and passed it, and with the changes we introduced GST. And one more very important provision related to that is, simply remember, we have inserted Article 279A under GST. We have added one more provision in the Constitution, Article 279A. Right? What is the meaning of it? Article 279A says that we have to have a new authority by the name of GST Council. Now, simple question to you people. If I'm adding an article in the Constitution of India and I'm establishing one authority, can I call this as a constitutional body? Let me know if you disagree. Right? I've added an article in the Constitution, and as a result of this, I will establish an authority. Can I call this as a constitutional body? Answer is yes, by the way. So GST Council is a constitutional body. Remember that. This GST Council has been set up or established by the President of India. In the GST Council, we will have representation of the central government as well as the state government. So the most important composition of the GST Council is, it will be chaired, or the chairperson will be from the central government, that is obviously the Union Finance Minister, and from the state government, the state finance ministers will be representatives in this. Now have a look at this. The Union Finance Minister will be the chairperson. What is the function of the GST Council? Simple. The GST Council will decide anything related to GST. For example, whether this good should be brought under GST. If it is brought under GST, what should be the rate of GST? Should we exclude it from the GST? Should we change the rate of GST applicable on it? Etc., etc., etc. Anything related to the GST, it is under the purview of the GST Council itself. So far so good. Can I go to the next one? What type of indirect taxes have been subsumed? Subsumed means included under GST. This is the list of the taxes at both the central level as well as the state level. In fact, some of you are asking, sir, it is the exhaustive list. Is it the complete list? Answer is no. At the central plus state level, around 40 types of indirect taxes as well as cesses have been brought under GST. I'll repeat the statement. Both at center plus state level, around 40 types of indirect taxes and cesses have been brought under GST. Should you remember all the 40? No. And should you study about all these taxes individually also? Absolutely no. Please do not waste your time. Reason is simple, right? There is a tax called as additional customs duty, central excise duty, right? A central sales tax, right? A purchase tax, etc. Earlier, maybe 10 years ago, these were important. But today, they are not an individual tax. There is no octroi tax now. There is no purchase tax. There is no central excise duty separately imposed like this. All these are part and parcel of GST now. Simple. All these are part and parcel of GST. So I've seen many books giving you 10 pages on all these taxes. Please don't waste your time, right? UPSC will not ask you that. For a very simple reason, there is no independent taxes like this. All these are part of GST. So this is the list of the taxes which have been subsumed under the GST. What are the other features? Regarding the GST Council, have a look at this. Quorum requirement is 50% in the GST Council. What do you mean by quorum here? Quorum simply stands for what should be the minimum presence. What should be the minimum number of people who are present? Let me give a very simple example. Imagine the finance minister is present. They are supposed to have a meeting. Finance minister is present. None of the state governments, they'll be present. None of them are present. Everybody, right, basically stays away from the council meeting. Can the finance minister alone start the meeting? I understand. Can the finance minister alone start the meeting? Answer is no. In fact, very recently, the term quorum was discussed even in the context of parliament. For the Lok Sabha to function, for the Rajya Sabha to function, there is a quorum requirement. Please read about it. It was there in the newspaper very recently. In the same way, even for the GST Council to start deliberating, there is a quorum requirement. That is, at least 50% of the total strength of the council must be present. Is it okay? I'll repeat it. At least 50% of total strength of the council must be present. Only in such a situation, the GST Council can start the discussions. Otherwise, they are not allowed to start the discussions. That is the requirement of a quorum. What about the decision making of the council? How the council can take decisions? Simple. The council can take the decisions either through consensus. Consensus simply means there is no opposition. Simple. There is no opposite, right, or opposition voting. Everybody agrees. That is consensus. Do I have the consensus now? So far so good. Do I have the consensus or not? Or is there anyone who will simply cross and say, sir, I want to vote against it? So argument is simple. Consensus means everybody agrees. Sir, quorum, again I'll repeat it, understand this. Quorum means what is the minimum strength that should be present. How many people should be present in the meeting to start the meeting? That is quorum. 50% of the total strength of the council is the quorum requirement. So in case of decision making, one, you can go through consensus. There is no problem if there is a consensus. But what if one state government says, no, I will not agree to it? I'll give a very simple example. Imagine the finance minister says, I have a proposal here. We should increase the tax rate on the bottle from 12% to 18%. GST should be increased to 18%. Some states will agree to it. Some states will not agree to it. Now, how the decision will be made? How the GST Council should decide in this? Then there is a concept of voting. Right? Basically, for a decision to be made in the GST Council, you require at least 75% in favor. I repeat, for a decision to be made at the council, you require at least 75% voting in the favor. meaning at least 75% of the votes should be in favor of increasing the rate on the bottle from 12% to 18%. That is point 1. Second point, now how the voting is decided. How much voting right is given to the center, how much is given to states. Simple, remember this. 1/3 of the voting right is given to central government. So out of 100% vote, 33% is given to center. And remaining 67%, again before you start reminding, it is not 33, it is 33.33333. Round it off. Sir, it is not 67, it is 66.66666 till infinity. Round it off. So 33% is given to center, 67% is divided equally amongst all the states. In fact, states plus union territories, remember this. The states, right, including union territories here, even the union territories which have legislatures, is it okay? The union territories which have legislatures will also be present here. So next point, 1/3 of the voting right will be given to center, remaining 2/3 will be equally divided amongst the states as well as the union territories. So the decision making of the GST Council will be taken with at least a 75% majority. What is the meaning of it? I'll give a very simple example. Right, this is 67%, and let's say hypothetically, each of the state will get somewhere around 2.15%. You can sit later, have a calculation how much it will come. It will come somewhere around 2.1% per state. Now, let me take the same example. This is the bottle. Finance Minister says we should increase the GST on this from 12% to 18%. Let's say 5 states will oppose. 5 states will simply say, no, we don't want it. And remaining states, along with the central government, want it to be increased. Now, is it okay if I calculate like this? 5 states, if they vote against the policy or against the proposal, that I'll just simply round it off. 10.5% of the votes are against. Is it okay? 10.5% of the votes are against. Remaining around 90%, around 90, it will be less than 90. Around 90% of the votes are in favor. Any difficulty here? 5 states, equal voting right, 2.1%. 5 states are opposed, which means 10.5% of the votes are opposed. Remaining around 90% are in favor. Is 90% greater than 75%? Of course, the answer is yes. So can the decision be made in the council? Answer is yes. Decision can be made in the council. Now, some of the states, right, would simply say, or some of you would simply say, sir, what if some of the states are absent? Neither do we know they are in favor or opposed. We don't know. In that case, what they will do? Remember this particular point. This 75% majority is based on present and voting. In polity, you will come across the concept of present and voting. That is, let's say 5 states are absent. Forget about 5 states. What is the total weightage present in the GST Council? 75% of that we will take. Now, is the logic okay? Can I go to the next one? Do I have a consensus? Can I go to the next one here? If you do not answer, I'll simply assume there's a consensus. I'll simply go. Okay, great. Let me go to the next features. We have a concept called as a dual GST. In India, we have basically borrowed this concept of a dual GST from Canada. Canada also has a dual GST model. Now, what is this dual GST? Simple. These are the slabs under GST. What do you mean by slab? Rates. GST rates 5%, 12%, 18% and 28%. Now you take up any rate, right? I hope you understand. You take up any rate. For example, take up 12%. 12% is divided into 2 equal parts. 2 equal parts. 6% and 6%. This 6% is called as a central GST and this 6% is called as state GST. Is the logic okay? I'll repeat it again. We have different rates of GST. We have 5%, we have 12, 18 and 28%. You take up any one of these, we always divide this into two equal parts. One part is called as a central GST, in short CGST, and another part is called as a state GST, in short SGST. SGST and CGST. Now, what is the importance of CGST and SGST? Simple. CGST will go to the central government. SGST will go to the state where consumption has happened. I will repeat it. Understand this very carefully. CGST will go to the state. CGST will go to anyways the central government. SGST will go to the state where consumption has happened. A simple question to you people. GST, is it a destination based tax or origin based tax? Let me see. Right, I repeat. GST, is it a destination based tax or origin based tax? Both. How? Anushka, origin, how? How, my dear? GST is a destination based tax. GST is a destination based tax. Remember this. Government of India also says it is a destination based tax. Right? So please be very careful. GST is a destination based tax. Why? If a good is manufactured in A, it is moved across the border and it is sold in the second state B and consumed in the second state B. Don't you think SGST will go to the second state here? Simple. SGST will go to the state where consumption has happened. So the state where consumption has happened is the second state in this example. So it is a destination based tax. Sir, you said central taxes are origin based. Yes, I said central sales tax is origin based. Please understand, I said central sales tax is an origin based. I am asking about GST. You're talking about CST. Both are different. Right? So GST is a destination based tax and right, CST is an origin based tax. Don't be confused between both of them. Okay, done. Right, so dual GST means what? You will divide the GST into two equal components. One component will go to the central government, that is CGST, and second component is SGST, will go to the state where consumption has happened. Now there is also a concept of integrated GST. What is this integrated GST? Whenever there is an interstate trade and commerce, we apply IGST. Simple. Right? The integrated GST simply means whenever interstate trade and commerce will happen, rather than simply writing GST, I will write it as IGST. Right? Is the logic okay? Is the logic okay? But sir, CST comes under SGST. Let it come. Whatever it is, again, don't complicate the things, man. Please don't complicate the issues. CST basically is a origin based tax. It went to the state where production happened. Under the GST, the state where consumption happens, SGST will be given to that. Now, don't you think the state where consumption has happened will get the tax component? That tax is a destination based tax. By definition, destination means what? The place where consumption happens, that place will get GST, or that place will get the tax. And I will prove it to you. Under GST, how the state will get that SGST, I'll prove it later. Have some patience. Next, certain goods are exempted from GST. Right now, alcoholic liquor for human consumption, it is not covered under GST. It is still, right, it is taxed by the state government. Remember this. It is still taxed by the state government. But please be very careful here. Whenever the alcohol is imported into India, right, look at my statement. Whenever alcohol is imported into India, who do you think should impose the taxes on it? Just think of it and answer to me. Alcohol is imported into India. Who do you think has the right to impose the tax? Central government. Some of you are saying state government. How? What is the thinking process? Imported taxes, do you think these are under the state government? Import taxes, my dear. Right? And if the product is manufactured in India and these are being sold, obviously it is imposed by the state government. Okay? So dual GST, that is a structure we have today. Some of the goods are exempted. Example I have given. GST Council to decide when to impose taxes on crude petroleum, diesel, petrol, natural gas, ATF, etc. That is the fuel products. These are there under GST, but the GST rate is not yet notified. I'll repeat it. The fuel commodities, right? That is ATF, petrol, diesel, etc. These are there under GST. But the GST Council is yet to notify. Notify means announce the rate of GST on these fuel commodities. Alcohol is not even under GST. We are yet to bring alcohol under GST. That is alcohol for human consumption. Okay? Right, so these are certain very important point. Next, connected to current affairs. Right, the next one is connected to current affairs. Very, very important concept of compensation. Idea of compensation. Now, what is this idea of a compensation? I'll come back to this, don't worry. Right, I'm just checking whether I've given the calculation. No, let me write it. So have a look at this. What is this idea of a compensation? Imagine here is a state government and 250, right? Imagine you're the chief minister of the state government, chief minister of the state. Now there are certain taxes which you are imposing and collecting, A, B and C. Let's say there are 3 taxes. You are imposing, you are collecting the taxes. Now is it okay if I say, as per your requirement, you will change the tax rate? Let me know if you disagree. As per the requirement, you will change the tax rate. For example, this year you want to spend more money, so you will increase the tax rates. Next year, you want to collect moderate amount of tax receipts, so you will reduce the tax rate. So as per your requirement, you could change the taxes. Now, what if I say, out of these 3 taxes, 2 are subsumed under GST. 2 of them have been subsumed. Subsumed means brought under GST. Now, follow my next question. I answer it very carefully. With these taxes being brought under GST, do you think you have the right to decide what is the rate of the GST individually? Think of it, right? You as a chief minister, you want to change the rate so that you want to collect more amount of tax revenues. Can you do that now? For A and B, can you do that? Answer is simply no. Why? Because these are brought under GST. The GST Council will decide, not only you. You alone cannot decide. Earlier, you had the power. Now, you do not have the power. Now, don't you think because of this, there is a concern over how much tax income you will be able to collect? Simple. How much tax receipts you will be able to collect? Don't you think there's a concern regarding that? That is point 1. Point 2, very important, follow this. Point 2, what if earlier from A and B, you collected 100 crore rupees annually? Simple numbers. You decided what should be the tax rate A, tax rate B. In 1 year, you collected 100 crore. Now, both of them are brought under GST, and under GST, you will earn 90 crore rupee tax income. Right? What about the remaining 10 crore? Who is going to pay that particular 10 crore? Don't you think there is a revenue loss for you? I hope you understand. Don't you think there is a revenue loss that is going to be incurred by the state government? So with this kind of uncertainty, would you like the taxes to be covered under GST? Right? Would you want the central government to introduce a GST, right, and bring all these taxes that you have the right to collect, impose and collect to be brought under GST? Answer will be no, by the way. I hope you understand. Right? You as a minister, you will simply say, no, sir, because there is so much of uncertainty there. What if I incur lower amount of tax revenue, or if I collect less amount of tax revenue under GST? Who should be, right? Who should pay that extra amount to me? Lot of concerns were there. In order to address this, government basically introduced the concept of compensation. Right, have a look at this. Government introduced the concept of GST compensation. Right, what is the idea of a compensation? Simple. There is a lot of calculation here. Don't worry about calculation. What government did was, right, basically this concept. Follow this carefully. From 1 year to the next year, government simply assumed your revenue will increase by 14%. First point, follow this carefully. From 1 year to next year, government assumed that the amount of taxes you are going to collect, of course, when I said tax revenues, two important points: GST revenues and, right, understand this carefully, from those taxes which have been subsumed under GST. Is it okay? I'll repeat it again. Under GST, that government, in order to ensure that you are not worried about how much amount of taxes you are going to collect, government said, from 1 year to the next year, I will simply assume that amount of taxes you are going to collect will increase by 14%. Right? What do you mean by that? Imagine last year, I'll take from the base itself, that is 2016, because 2016 GST was implemented. Imagine you are supposed to, or you collected 100 crore rupees. You collected 100 crore. Now, if I simply assume it as a 14% increase, is it okay if I say next year your expected revenue, your expected revenue will be 114 crore rupees? Any difficulty here? Right? I hope you understand. The government assumed from 1 year to next year, you will earn 14% more revenues. So if you collected 100 crore rupees last year, next year you will simply collect how much? 114 crore rupees. Now what if rather than collecting 114 crore rupees, you collected only 80 crore rupees? Under GST, you did not get 114 crores. You ended up collecting only 80 crore rupee taxes. So this will be referred to as expected revenue collection under GST. This is actual revenue collection under GST. So this shortfall is referred to as revenue loss. The shortfall is referred to as revenue loss. Any problem? Any problem? Do let me know. Otherwise, I'll go to the next point. Right? Government simply assumed from 1 year to next year, the amount of GST revenue collection will increase by 14%. But if your collection is lower than, right, that formula 14%, that is expected revenue collection, you know, but your actual collection is less than that, then this will be referred to as a revenue loss. And Government of India would simply provide this 34 crore rupees to the state government. Is it okay? That 34 crore rupees will be given by the central government to the state government. This concept is called as GST compensation. Is it okay? This concept is referred to as GST compensation. Government of India stated that once I start implementing GST, which has come into force from how many years? It has been more than 5 years now. 1st July 2017. So 1st July 2017, government introduced GST. So government said, from the date of implementation for the next 5 years, I will provide compensation, 100% of the revenue loss in the form of compensation to the state governments. Meaning during this period, in any year, if there is a revenue loss based on this calculation, if there is a revenue loss that is going to be incurred by the state government, whatever is the revenue loss, that will be paid by the center to the state governments. This concept is compensation, GST compensation. Now tell me, did we complete 5 years of GST implementation? Just think of it. Did we complete 5 years of GST implementation? Answer is yes, by the way. Right, June 2022, we have completed 5 years of GST. So should the central government pay after 5 GST? No, central government has discontinued, because 5 years is over. Central government has discontinued payment of compensation to the states. And in fact, in today's newspaper, if you have read, there is a discussion related to this. That is, the states are demanding for more and more compensation. That is, compensation for more years. That is a demand. Central government has not agreed to it. Is the logic okay? Anybody has an issue with this? Explain again compensation. My dear, from where? From where? Right? If you simply say again explain, it simply means I'll have to go back 15 minutes. So argument was simply this. You are giving away the taxes. You are giving away certain taxes to the central government to be included under the GST. Now, what if under GST, you will not earn sufficient amount of revenues? And the problem here is, unlike current situation, that is GST, earlier, you are the chief minister, you could change the rates of the taxes. As per your requirement, you could simply change it. But currently, you don't have that power. GST Council has that power. So there was a concern that if I give away the indirect taxes to the GST Council, what if I don't collect sufficient amount of revenues? Who is going to compensate me? Who is going to pay me those revenues? In order to address that, the GST compensation has been introduced. 14% was the standard number. From the last year to this year, we simply assume that the receipts or the revenues will increase by 14%. If you are not going to collect the expected amount, the shortfall will be paid to you in the form of compensation. Simple. Right? So 5 years is over. Compensation has been discontinued now. Last point before the break. Last point. If the central government wants to provide compensation to you, central government should have money. All of you will agree? If the government wants to give you that compensation, government should have the money in the first place. So what did Government of India do? They introduced the concept of compensation cess. Right? Remember this. Some of the commodities that were covered under 28%. I'll give you examples. Okay. Some of the commodities, right, which were covered under 28%. They targeted these commodities such as aerated, right, beverages, such as tobacco products, etc. And apart from 28% GST, they were also imposed with compensation cess. They also imposed compensation cess. And any amount of money that was collected through the compensation cess was utilized by the central government to pay compensation to the states for a duration of 5 years. This is basically the concept of a compensation, very much relevant. Although Government of India has discontinued the compensation, the states are demanding this. And that's the reason very often these are there right in the newspapers. Done? Do not understand GST 28%. My dear, certain commodities were classified or basically divided, or let's say, imagine 1,000 goods and services are there. I will divide the 1,000 goods and services into different groups. On some of these, I will impose a 5% GST, on some 12%, on some 18%, on the remaining 28%. That is basically slabs. Okay, this is called as a slab system. Okay, right. So these are some of the very important concepts related to GST. Let me take the lunch break now. After the lunch break, we'll start from this slide. That is, what are the issues related to multiple tiers? Multiple tiers means again slabs. Slabs or rates. For example, I've written here 5%, 12%, 18 and 28%. These are called as multiple slabs or tiers. Right? So what are the reasons? Why did Government of India opt for this? If they have opted for this, what is the problem then? Right, so let's start with this critical evaluation after the lunch break. Now, before the lunch break, right, let's say, sir, in the initial situation when passing from A to B isn't after introduction of VAT, doesn't central government lose as before if the government was not providing any ITC? My dear, please understand, the whole idea of a GST is not to be focused on the GST collection. It is to make businesses much easier to operate in India, to increase investments, right, to produce goods and services, reduce the market price, export more, produce more, right? So argument is simply this, right? If you simply say, sir, under cascading effect government was collecting more taxes, now under if you eliminate cascading effect, government will collect lesser amount of taxes. That's a fact. But would you want a cascading system, not taxing, cascading system? Would you want to be a manufacturer in a country where there's a cascading effect? Answer is simply no, right? So that is the reason. So does cascading effect provide more tax income? Yes. Under cascading, if you look at only one transaction, of course, yes. But that will affect investments. That will reduce competitiveness, right? There are certain negative aspects related to cascading effect. Okay. How IGST is divided? IGST, CGST is taken as it is, and right, whatever is the SGST component is given to the state where consumption has happened. I'll show that later. How many goods are covered? More than 1,000. More than 1,000. Okay, done then. Let's take a break now. It is 3:10, right? Almost 3:10. I'll start at 3:50. Right? I'll start at 3:50. Okay, let's restart again at 3:50. Take a break.